of the dollar, I think, will gradually reduce, albeit, of course, there are still cross currents, not least of which in relation to US political dynamics.
Jeremy Stretcher, CIBC, looking for a swing in the other direction. Jeremy, appreciate it. Looking ahead to the BOJ and the Federal Reserve next week. I think Lisa took this conversation in the right direction. When you have a big consensus trade like this one, short Japanese yen, for this long, other things are kind of built on top of it. So when you snap back the other way with speed, and it's the speed that matters from, say, 160 down to 150, things start to crack elsewhere. Identifying where those cracks are and where they're coming from is important.
Yeah, and I don't want to spread rumors saying that someone blew up, because there's no evidence to suggest that. It's just simply, there seems like perhaps there were a few, I don't know, trades that sounded and rhymed very similar that were leveraged that got blown out at the same time. And we saw the unwind of that. And that's what a lot of people have been talking about. Very hard to attribute some sort of fundamental reason behind that.
Dollar yen has had a 157 handle this week and a 151 handle this week as well. That's quite a range. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Mercedes is the latest automaker reporting a decline in its second quarter profit. It trimmed the upper range of its forecast. It now expects returns on sales between 10 and 11%. It previously said the high end could be 12%. Automakers are under pressure from weaker demand in China and a drop in purchases of battery-powered cars in Europe, with governments cutting back on financial incentives. Mercedes shares fell as much as 3% in the early trade before paring some of those losses, given weak earnings were somewhat expected. Shares are flat over the past year. And JP Morgan has launched a new internal AI chatbot in one of Wall Street's largest use cases for the technology. In a memo viewed by Bloomberg, JP Morgan told its employees to use its own version of ChatGPT as a writer, idea generator, and problem solver. The FT earlier reporting that the chatbot could do the work of a research analyst. Many of the big banks have been experimenting with AI over the last year, with hopes it lives up to its productivity and cost-cutting potential. Citigroup has estimated that the technology could displace more jobs in banking than any other industry. And former First Lady Melania Trump is publishing a memoir this fall. The self-titled book is described by her office as a, quote, powerful and inspiring story of a woman who has carved her own path, overcome adversity, yes, and defined personal excellence. The book will sell for $40. A signed copy will be available for $75, and a collector's edition will go for $150. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next, big policy questions on the horizon.
The trajectory for debt and deficits is quite dire, regardless of who gets elected. I think that that's something that the next administration is going to have to address.
Up next on the program, the former World Bank president, David Malpass from New York. This is Bloomberg.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
If you are just tuning in, welcome to the programme. Equity futures bouncing back. Pretty volatile session yesterday, and I have to say, pretty volatile week. Equity futures up by 0.75% on the S&P. In the bond market, yields just about unchanged. The 10-year 4.24. Under surveillance this morning, big policy questions on the horizon.
The trajectory for debt and deficits is quite dire. Regardless of who gets elected, I think that that's something that the next administration is going to have to address. It makes it very tricky for the Fed to be able to cut rates, in an environment where debt and deficits and long-end yields could potentially rise if the market and the bond vigilantes start to kind of push back on the narrative that's put forth by the administrations that come to power.
So big week ahead, and here's the latest this morning. Treasury's holding steady after recent gains as optimism grows over the Fed's first rate cut. Bond traders also looking ahead to next week's quarterly refunding announcement from the Treasury Department. Alongside us in the studio here in New York, the former World Bank president, David Malpass. David, good morning to you, sir.
Good morning, John.
I want to start with this quote, and I think this is a timely conversation for us. It comes from Hudson Bay Capital, Stephen Mirren, Nouri Arabini, two people I'm sure you know well. Here's the quote. By adjusting the maturity profile of its debt issuance, Treasury is dynamically managing financial conditions and through them the economy, essentially taking over the core functions of the Federal Reserve. And they dub this novel tool activist Treasury issuance, or ATI. Can we just reflect on all of this? What did you make of this piece? What are they telling us?
I love new acronyms, ATI. So activism, so Treasury has to decide every quarter whether to issue T-bills or bonds and which bonds to issue. And they do that in conjunction with Wall Street. And the problem, and I've written a lot about this in the Wall Street Journal, is that puts an overlap between them and the Federal Reserve. So that's a challenge right there. As you decide where the issuance is going, it affects the shape of the yield curve, and when you do that, you're affecting stock prices. So you've got this giant direction for capital based on whether Treasury is borrowing short or long. Right now, for years now, they've been borrowing too much at the short end and not enough in the 10-year kind of window, the 30-year window.
And why does that deliver meaningful consequences? Can we explore that a little bit more? If you think about the shape of the yield curve, it's the same amount of debt. It's just being issued at the front end of the yield curve and less at the long end. Why are there meaningful consequences when you increase or decrease the level of debt at the longer end of the curve?
When QE started, that was the Federal Reserve buying a lot of bonds in, say, 2010, 11, 12, 13. That flattened the yield curve. So you had the Fed buying longer maturities, basically the Fed buying duration. So when the market hears that, that's positive for equities, but it's not positive for small businesses around the country. They borrow at the short end. So basically, Treasury is the Bigfoot coming in and borrowing right at the spot where your small businesses want to borrow for inventory, for construction loans. So if you could change the shape of the yield curve to be more upsloped or upsloped at all right now, you would liberate a lot of floating rate loans for people that really need them day by day in order to get their businesses growing.
Some people could say that this is actually just smart policy because ultimately the Treasury Department didn't want to lock in borrowing costs at 5% for the next 10 years. And they wanted to have a short-term kind of lease on rates that were at the highest levels in decades. Why don't you see it that way?
Hi, Lisa. I think that's a bet made by the Treasury. So we already saw a giant bet made by the Fed on duration, and they've lost, billions and billions. And I think it will end up being $1 trillion from that mistake when they were buying long bonds with short-term interest rates. Think Silicon Valley Bank, or think a hedge fund that made a bad bet. So as Treasury does that, they should be more neutral about the economy. Here we are coming into an election cycle, and they have they're holding down the long end of the curve, which props up the equity market. it fuels, think of where the capital is going right now. Treasury is borrowing short, so it means a lot of long-term, long-duration capital can go into equities or can go into long-term bonds. So you have this phenomenon for years now of corporations issuing bonds and buying back their stocks. You've got dividend recapitalizations going on now. This is all a phenomenon of the shape of the yield curve, which is being controlled, I think, in an anti-growth way by Treasury and the Fed.
This may sound like an esoteric conversation. It's pretty much anything but. It's talking ahead of 8:30 a.m. on Wednesday, when we're going to get the Treasury refunding agreement, where they announce what kind of maturities and the amounts that they're going to be selling of government debt. It comes at a time where Fitch said in a recent report that heavy Treasury supply is a key risk to our lower yields call across the curve. And it comes at a time when you potentially are rumored to have an ear toward another administration of Donald Trump. What would you, if you were in a situation to dictate maturities, do in order to, say, increase maturities of U.S. government debt while not sort of causing this massive sell-off at the long end that could be hugely disruptive?
Yeah, and I think you have to be neutral from Treasury and from Fed, that you're not trying to manipulate the yield curve. You know, historically, there was remember the Operation Twist, which was a big failure in a previous decade, a previous century, and so the government has tried to do this, and it ends up hurting people within the country. So all you have to do, I don't think it's that hard, is say what your goals are, that you're trying to not have the short-term funding be the most efficient. The Treasury is making a bet right now that they'll be able to refund at a lower yield later on. How do they know that? And wouldn't it be more confidence-inspiring if they allowed the market to help them do that? They're asking the world to keep giving, you know, the U.S. borrowed, the Treasury borrowed in 2023, $23 trillion in its coincidence in 2023. And so that's a giant amount of debt for the market to digest. So say to the market, we are working toward a lower yield curve that's upsloped, that's going to maximize business confidence and be very positive for growth. They're not doing that. They're saying instead, we're going to keep borrowing short term because, as Lisa's pointing out, it might be cheaper if yields fall. It might cost them a lot. Right now, it hasn't been a good bet. If you look back,
the core principle, as you know, David, just to jump in, is meant to be regular and predictable debt issuance out of the Treasury. That's meant to be the core principle. Do you think we've moved away from that? Do you think this is a permanent fixture of policy now, this tool?
Clearly, it depends on the political cycle where you're going to borrow on the yield curve, and if you're trying to prop up markets in the short term or the long term. And that also affects, and it's very important, the actual capital flows going on in the economy. So there's been this heavy bias toward big companies and toward the government. So, you know, that same point that you're making about where the Treasury is issuing means that the government, it feels comfortable with this giant fiscal debt because you're not borrowing at the long end of the curve. I think we need to go to a more neutral, balanced environment with a more independent Fed that's not really facilitating this process through its own. Is it coincidence that the Fed moved to QT to phasing out QT right now in this part of the curve? They should be allowing that long bond portfolio to run off. That would be confidence inspiring for markets.
David, it's good to catch up with you, sir. I feel like we've only scratched the surface and we need to go a lot deeper on this topic. Thanks for giving us your insight. David Malpass, the former World Bank president, on a key issue. That note and that research from Nouriel and Stephen, it has had so much attention over the last week or so.
If you extrapolate it out, there's a real question, what is the consequence of higher long-term yields if you do allow them to be determined by market prices? And there was sort of this implication, maybe U.S. government officials would take the deficit more seriously if the market were determining levels. Maybe it would be more of a gut check that would actually push people to a bit more action on the policy side.
Well said.
Thanks.
Well said. Coming up next, got David sort of nodding his head as Lisa's talking as well.
Well said.
Well said. Coming up next, Victoria Fernandez of Crossmark, Sucharita Kadali of Forrester Research. We'll catch up with Giorgio Falani, the AC Milan CEO, and Sheila Kaiolu of Jefferies. All of that and more in the second hour of Bloomberg Surveillance.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
One of my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery. Okay. It was just Warner Media at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships, and you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold, and by the time we turn our battleship around, you've already taken the gold. I go, that's right. I'm always gonna be that entrepreneur. Mm-hmm. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station, asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that dining room table trying to pay his phone bill is that same guy today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Fed doesn't want to appear panicked, particularly when the underlying breadth of data do not suggest the broader economy is falling out of bed.
We're getting a little bit too carried away with negative surprises where, in fact, we are still seeing broadly stable data.
If the labor market starts to show signs of weakness, we have to go faster.
The data right now does seem consistent with an adjustment cutting cycle. You're seeing that gradual cooling.
I think rate cuts are definitely coming. I just think that at this point, there's not a really strong case for waiting.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance begins right now, and it begins with a snapshot of your equity market. And this equity market has been all over the place over the last week. Monday was the best day of gains since June. Almost forgotten about that, haven't we? It was a nice bounce back a little bit earlier this week, and then Wednesday happened, which was like the worst day of losses so far this year. And then we added to it yesterday, even though literally 15 minutes before the close yesterday, it felt like we might finish in positive territory. Lisa, all over the place is the right way of describing this equity market.
And part of the reason why is because there just isn't necessarily a clear compass. The economic data has had ups, has had downs, hasn't necessarily been particularly consistent. And frankly, neither have corporate earnings. I mean, yesterday we were talking about Ford having its worst day going back to 2008. We're talking about American Airlines slashing their full year forecast. Today we get 3M boosting profit forecast, Colgate raising its full year organic growth models, Bristol Myers beating. It is an inconsistent and difficult picture to really wrap your head around.
People always use that word, don't they? And it frustrates us both. Idiosyncratic. Stellantis, idiosyncratic, because obviously there's this EV thing going on at the moment and they're at the wrong time, at the wrong place and all of that. Then you look at another company and you can make another excuse. Kering, well, they've got Gucci. Gucci can't execute. And I think that's the difference for me. What is it about execution? And what is it about the US consumer right now? Where's the real struggle? Are people just not executing, or are they just struggling because the consumer's weakening?
It's a great question. And to me, the answer really lies in what does it mean to execute? Is it just simply the right types of strategies, or is it the most cost-efficient strategy? Are we talking about cost cutting? You know, Bristol Myers talked about that. McDonald's just talked about how the $5 meal is bringing more people back into the fold, and they extended that because people are much more cost conscious. When you start talking about efficiency, cost cutting, you start thinking about job cuts and other things like that. How deep does that go? And that really ultimately, I mean, people are getting sick of this, but it goes back to weakening or weak. We just aren't sure, but right now people are still coalescing around weakening, and it's healthy and planned.
Well, it's certainly weakening, without a doubt. Let's just pick out two names. Two of the biggest food and beverage manufacturers on the planet. Pepsi, Nestle. Pepsi, in the US, there is clearly a consumer that is more challenged. Nestle, there is value-seeking behavior among consumers. You can't avoid this. You can't call that idiosyncratic. That's a consumer pushing back, and that's a company losing pricing power, and we've seen that repeatedly.
Take Nestle, cocoa and coffee, right? They're basically cocoa beans and coffee beans. Both of them have gotten more expensive. This is commodity prices increasing on their input costs. So they cannot pass it along to consumers. Cameron Dawson was talking about this yesterday, that you start to see margin compression or margin relief, as Ben Liedler would call it, at a time when inflation is coming down, that it might be good for the consumer, but it tends to be bad for corporate profit margins. Is this a company-specific problem and not necessarily an economic problem? No one's really able to get their head around that right now.
When there's enough companies having the same problem, you've got an economic issue, right? Because they're cutting costs.
And they're cutting jobs. And that is clearly what we're seeing. And the backward-looking revisions of what people are watching. How much do we not understand the real-time data, because it's going to get changed so much when we take a look at what it really was a couple months later.
You just get the feeling from a market perspective, things are so finely balanced, you're like one bad data point away from this all changing. Michael Hart at Bank of America basically said the same thing. One bad payrolls report away from changing this whole story for some of the biggest companies on the planet.
I also think a lot of people aren't really necessarily conditioned for this type of environment. We've seen huge swings, right? We saw the 2008 crash. We saw the pandemic. Everything kind of went at once. And this has been a story of many different industries that are moving at their own paces. We see services side inflation coming down. We see goods inflation coming back up, actually already having seen that trough. And all of a sudden starting to get more expensive because cocoa beans are getting more expensive, because some of these companies are saying, well, maybe we need to cater to a higher end consumer in order to be more profitable.
We can talk about the airlines later, but I was thinking about American trying to pivot, Southwest trying to pivot, at a time when maybe the high-end consumer now is starting to push back as well, based on what we've heard ex-Hermes in the luxury state of play.
Assigned seats in Southwest.
I know, it's a big change.
Have you ever actually flown Southwest?
I haven't, but I've done Ryanair.
Okay, it's basically the same thing.
At the you know, sort of like when Ryanair peaked, late 90s, when you sort of run across, you know, early 2000s, you'd run across the tarmac to try and get a seat and elbows out. Yeah, oh yeah, then you'd have to like try and save some for the family to make sure no one else sat beside you.
Did you ever elbow someone out of the way and then have to sit next to the person
I would never
you
get
elbowed
physical,
out?
Bramo.
Okay.
I would never do that.
Can you imagine?
No, that would be pretty awkward.
Really
but I'm sure that happened. You know,
all the time.
Back in the day, Ryanair was pretty brutal. I'm happy that Michael O'Leary changed things, because that wasn't a nice experience. Equity futures right now on the S&P 500 look like this. We're positive by 0.7%. In the bond market, yields 4.24 on a US 10-year. The euro just about unchanged, 108.54. I want to sit in the commodity market just for a beat. 77.92, down about 0.5% in crude. And I mentioned Michael Hartnett of Bank of America a little bit earlier. Look, one person's sell-off and growth scare is another person's rotation and broadening out. And I think it's really important to sort of separate those two camps right now. And you can give each camp some fuel. And this is what Michael Hahn is talking about. You can look at one and say, look, credit spreads are okay. They're still pretty tight. The economy's fine, and so is this market. This is just a broadening out. But when you look at commodities and look at what's happening with the yield curve, particularly the rally at the front end of the curve, you can make the argument that a growth scare is starting to emerge.
Take a look at copper prices. I mean, aside from just sort of the yield curve, the forward contracts, near term versus long term, take a look at how much copper prices have come down. Why? Is that because of some sort of normalization after an incredible boom, or are people starting to sniff out that maybe that commodity boom, that building infrastructure kind of development isn't happening as quickly as they previously thought?
We'll get some thoughts on commodities for you in just a moment. Here's the state of play for this hour. The next 55 minutes or so, we'll catch up with Victoria Fernandez of Crossmark on the Great Rotation, Sucharita Kodali of Forrester as the US consumer pulls back, and Sheila Kayolu of Jefferies on volatility in the airline industry. We begin with our top story, the S&P 500 notching losses for the 6th time in 7 sessions as the rotation trade continues. Victoria Fernandez of Crossmark writing this: we are invested in the market, but with a weakening labour market, higher credit card and auto delinquencies, and seasonality shifts, we could see a softer second half of the year. Victoria joins us now for more. Victoria, I want to start with the consumer. Lisa and I spent some time talking about that. There's a few companies out there saying things are weakening. Others say things are okay. What are you focused on?
Yeah, well, Jonathan, I think this is the problem that we're seeing. We don't have a consistent message coming from the earnings season telling us one way or the other so that the market can make a definitive decision on where it wants to go forward. That's what's causing some of this volatility that we're seeing in the market, especially like yesterday, up all day and then down at the end. So in our eyes, it all comes down to the labor market. You and Lisa were talking about this earlier. The labor market is key for us, and not necessarily the payrolls number. I'm looking more at the JOLTS number. I want to see those job openings. I want to see how long it's taking someone to find a job once they leave somewhere. Temporary work, we know that is a precursor to what we're going to see in the labor market as a whole. I think that U3, U6 number has kind of muddied the waters a little bit with the immigration issue. So I think focus on JOLTS, get an idea of that labor market, because it flows through to everything else we're seeing. It flows through to wages. Then you have the consumer pull back, and we know the consumer is driving this economy. You get consumers pulling back, revenues pull back, margin compression, layoffs go up. It is a cycle. I talked about this with clients in Kansas City yesterday. Follow that cycle, and it tells us things are going to slow down in the second half, and we need to be ready for that.
So, Victoria, here's the question I would have for someone like you who likes financials. Why on earth would I want to own the banks going into what you've just described?
Yeah, I think we have to look at it from a technical side as well as a fundamental side. I know, Jonathan, you asked me a couple months ago, why are we sticking with financials? And look at the run-up that we have seen. It comes down to the fact that when you're going to have volatility in a market, we had the VIX up to 18, up 20% this week. You need to have companies that have strong balance sheets, good cash flows. They can handle this storm. If we're getting a re-steepening of the yield curve, which we typically get before we go into a recession or a pullback, I hate to use the word recession anymore, but as we go into a pullback, that actually will be beneficial for some of these financial companies. But we're talking the larger banks. We know Russell 2000 has done better because of some of the regional banks, but we would say stick with these larger banks with the good balance sheets. They still have people using their credit cards and paying those off. Even though delinquencies have risen, consumers are going to rely on those credit cards as well. So I think you have a couple reasons as to why in a market where a lot of elements are going down, financials still have over half of their securities in that sector over their 50-day moving average.
Victoria, you talk about diversification across sectors and across asset classes and how important that is. What does it mean to be diversified right now at a time when we've seen sort of odd correlations and a lot of the traditional sort of 60-40 aspects of portfolios haven't been reliable?
No, you're right, Lisa. And we were actually just looking at correlations in consumer discretionary this past week and how that has really fallen out of bed. You really have to be specific when you're going in and looking at names, really doing that homework, looking under the hood on the fundamentals. But for us, diversification doesn't just mean within the equity sector. You know, we've been talking about financials. We've been talking about healthcare. We've been talking about some of the staple names that have pulled back in the first part of the year as areas to go into. But we also also think you need to put some money to work in that fixed income world, lock in some of those higher rates, at least for the next 18 months to 2 years, to help buffer some of the volatility in the equity market. But look, there's other elements. Generate some income in your portfolio with call options. That's one of the most liked strategies that we have at Crossmark, where we're seeing a lot of flows come in. But you can also have allocations to things like absolute return strategies. So there's a lot of elements where you can go in, build your portfolio out to really kind of buffer some of this volatility. It's not just within the equity sector.
Next week's massive. I know you know this. We've got the big tech earnings from Microsoft, Apple, Amazon, and Meta. We have, of course, the payrolls report on Friday. And then on Wednesday, the Fed meeting, as well as the Treasury financing or funding agreement, which actually could be important for duration. Absolutely. What do you think is going to be the biggest market-moving event among those?
Yeah, I think it's really hard to pick from those. But I will tell you, I'm actually going to be watching the quarterly refunding announcement. When we look earlier this year, some of the biggest spikes that we've seen in yields have come on the quarterly refunding. Obviously, the deficit is a huge issue, and people are very concerned about what's happening there. And that gives us a clue into what our interest expense is going to look like, and issuance going forward could lead to downgrades for us from some of the rating agencies. So to me, that is extremely important. We know that some of these tech names, valuations are coming down a little bit. So I don't think we'd be completely surprised if we see earnings just hit expectations, maybe not go further, and guidance come down. I think we know the Fed is using this meeting as a setup for September. So to me, actually that quarterly refunding, I think, could be key.
Victoria, do you share this view that the Treasury is deliberately manipulating the shape of the yield curve by issuing more at the front end of the curve?
Yeah, I was listening to your conversation with David Malpass, and I'm not sure if they're trying to deliberately change the shape of the yield curve, but I do think they're trying to go in and figure out a way to reduce interest expense going forward. If they can issue more T-bills in doing that, which we've seen in previous refunding announcements, then I think that benefits them. So I'm not sure if it's an intentional yield curve movement. I do think it's intentional to try to reduce interest expense, again, leading to the idea that we could get downgraded if that continues to go higher.
Victoria, appreciate your view going into next week. Victoria Fernandez at Crossmark. Lisa went through a range of stories to look ahead to next week, including payrolls. Payrolls, the estimate in our survey. Sneak peek for you, Lisa. 175 is the median estimate in our survey so far.
How low is the bar for the market to change its narrative, or how high? I mean, this is sort of going to be the key question. It's not just the actual number. I still think that the revisions are becoming increasingly important as they pretty consistently downgrade the view from the month before.
Household versus establishment, still playing that game. Unemployment, by the way, the estimate in our survey, we're looking for that to stay at 4.1%. Let's give an update on stories elsewhere this morning with your Bloomberg brief. We can cross over to Danny Berger. Hey, Danny.
Hey, John. The world's biggest eyewear maker, EssilorLuxottica, says Meta is planning to buy a stake. The investment would see Meta push into virtual and augmented reality for smart glasses after years of the two companies working together. Luxottica's CEO made the comments late Thursday after weeks of speculation about the U.S. tech giant's plans. He added that if Meta decides to invest, it would have to buy shares on the market, declining to elaborate on the size or timing of that stake. And a top candidate to succeed Boeing CEO Dave Calhoun at the end of the year has emerged. Stephanie Pope, who runs Boeing's commercial airline unit, made the rounds at Farnborough International Air Show as the plane maker's highest-ranking official in attendance. Pope was promoted to chief operating officer late last year, making her the heir apparent, and Calhoun has publicly endorsed her as his natural successor. Vice President Kamala Harris has officially joined TikTok. Since she began her presidential campaign 4 days ago, TikTok and other social media platforms have seen a groundswell of viral memes, images, and videos featuring the presumptive Democratic presidential nominee. More than 95% of left-leaning TikTok posts about Harris currently have a positive sentiment towards her, according to Credito IQ, a social media analytics firm. Harris has more than 1.3 million followers. Former President Donald Trump, who has been on TikTok since June, has 9.2 million followers. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes. Nobody's dealing with that platform anytime soon. Just on fundraising, love this story. We'll touch on it more a little bit later, but I want to give you some numbers. So there is a cryptocurrency industry event taking place in Nashville tomorrow. there will be a private fundraising effort for Donald Trump, including asking prices. Get ready for this. If you live outside of America and you're not familiar with the fundraising efforts, this will blow your mind. The asking price of $844,600 for a seat at a round table. If you want the opportunity for a photo with the presidential candidate, $60,000 per person. And Lisa, if you want for $100,000 per couple, so if you want a photo for 2 people, you and your other half, $100,000.
Some people would say, why would anyone do this? And then we hear about how, you know, Elon Musk and some of his decisions to donate to Donald Trump would actually put him in a better position should Donald Trump be president, even if his policies seem like they are against his business. There is this sense that the more you have some familiarity with the potential future president, the better for you.
According to an invitation to the event, if you've got that kind of money, it's like 1 Bitcoin apparently in our story, 1 Bitcoin for a photo with the former president. Up next, the consumer pulling back.
There's a weakening in the U.S. consumer. Consumers are spending, right? But they're not spending as much as they used to. So I think it's a slowdown story versus a recessionary consumer spending print.
That conversation up next. Live from New York City this morning. Good morning.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The Fed decides.
Who said summers were quiet? I don't remember the last quiet summer.
We're talking about the data not being as accurate during this time of year, an election that's haywire.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Is the answer here, Jeff, that everything is just plain solid?
It's pretty solid, Tom.
At some point, we got to call it a soft landing.
Tune in to Bloomberg Surveillance. The Fed decides, starting at 1:30 p.m. Eastern.
Counting you down to the opening bell, attempting to get you to the weekend. Equity futures look like this. About 2 hours away from that open. We're up by 0.75% on the S&P 500. In the bond market, yields just about unchanged. The 10-year not doing much. 423.67. A bit of quiet. A welcome bit of quiet, I have to say. Under surveillance this morning, the consumer pulling back.
There's a weakening in the U.S. consumer. Consumers are spending, right? But they're not spending as much as they used to. If you look at credit card spending data, for example, if it was up 7 or 8% year over year, now it's maybe 3 to 5%, depending on what kind of a consumer you look at. So I think it's a slowdown story versus a recessionary consumer spending print.
Things are cooling. They're not cool. How many different versions have we heard of that over the last couple of weeks? That was from Michael Gapin at Bank of America. Here's the latest: consumers pulling back from post-pandemic revenge spending, and it's starting to hit the top and bottom lines of companies, from food producers to airlines and luxury retailers. Sucharita Godalia Forrester writing this: many consumer-facing retailers, Nike, Target and others, aren't doing particularly well. I don't know that that is economy related, but rather execution related. Sucharita joins us now for more. Sucharita, that is a really important distinction. And we asked this at the top of the program. There's an execution issue, then there's a consumption issue. Which one is which right now for many of these companies?
Well, in the case of some companies, like Nike's a good example, where the category may be doing okay. Their competitor, for instance, at this point in time, Adidas, seems to be having more traction. That suggests that the consumer isn't necessarily pulling back from the category altogether, or the subcategory in their case, and that issue is more related to perhaps their product assortment and some of their innovation levels. Now, from an overall consumption level, what we are seeing is that the numbers are softer than they were during the pandemic, but we have to also keep in mind that the pandemic, the economy experienced some of the highest levels of spending that we had ever seen. And that was even inflation adjusted. And then we had inflation coming on the heels of the pandemic, which ate into the real spending, but the consumer was still spending more. And now finally, I think what we are seeing is a leveling, and the consumer spending not more than the inflation level. And that's where we're seeing perhaps some softness in some of these discretionary categories, as well as some essentials too, like grocery.
Essentially, you're just saying don't confuse the process of normalization with something bad, something sinister. Is that a fair assessment?
I think that that is a fair assessment, and the truth is that it's not like we have seen spending fall off a cliff, and that's important. We had record levels of consumption, fueled by, of course, stimulus payments, as well as the market doing very well. So the consumer was in a really, really good place over the last few years, and it would have to be something pretty catastrophic for spending to fall off a cliff at this point.
Sucharita, can you give us a sense of history and where this week it might be that we're looking at? You pointed to Walmart, Costco, and Amazon doing well at a time where consumers are increasingly cost conscious. Yes, they are executing well. Yes, they've got economies of scale that allow them to execute well. But how much does this indicate a shift in consumer spending that gives a hint of what's to come? Maybe not falling off a cliff, but maybe a sense of where we are in the deterioration of the consumer appetite.
Well, the thing that is difficult when you look at a Walmart spend or even Costco spend is that those are businesses that do well regardless of the economy. They do particularly well when the economy is doing poorly, but they do well even when the economy is doing well, because the consumer is spending more, and they're going to be beneficiaries of just mass merchandise spend. So it's difficult to say right now, looking at those companies, whether that is because the consumer is feeling more nervous and cautious. Certainly, all of the consumer confidence figures are a little wacky, and this is where we have the Vibe session thesis that the consumer's feeling worse than the macroeconomic indicators are suggesting. We have to also remember that wages are still relatively high, unemployment is low, GDP growth, we just had the GDP numbers for so far yesterday, and those were really higher than what the expectations were. So the economy overall is doing well. These inflation numbers seem to be weighing down on consumer confidence, and that's why you see some of the softening that we're seeing.
Just quickly, do we still see just as wide of a divergence from upper income families and their spending versus lower income families?
That's definitely one of the theses out there. Some of the softening is that it's happening at the lower end for sure. The lower end consumer is the one that not only is going to be more likely to have to resume loan payments, and they're the ones that are going to have the higher interest rates from credit card debt that they're going to have to cope with. But and certainly the upper income consumer is the consumer that is more likely to be a beneficiary of some of the stronger stock market performance of the last year. But at the same time, that upper income consumer isn't seemingly purchasing those luxury goods, every luxury brand, which is a public company, has reported softening in sales. Although arguably that could be because of the China consumer, less so because of the U.S. consumer.
Interesting. Sucharita, thank you. Sucharita Kodali there of Forrester. That's the important one, the important development for me. It's how much of the spending that's helped prop up this economy is starting to break down as well.
Yeah, that's the reason why maybe we're seeing airlines in particular not being able to win out with just some of the top-tier seats.
Coming up on the program, a somewhat self-indulgent conversation with the AC Milan CEO.
Somewhat.
It's market focused, Bramwell.
It is. I've got lots of questions.
About the Russell and small caps and all of that good stuff.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the...
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Let's start with the price action. 2 hours away from that opening bell. Equity futures pulling back by 0.75%, or rather pushing higher by 0.75%. On the Nasdaq 100 up by 1 full percentage point. And once again, the outperformance on the small caps, the Russell 2000 up by 1.5%. I mentioned this stat earlier this morning, and if you missed it, it's worth repeating again. It comes from Jim Reed at Deutsche Bank. The Mag 7 down nearly 13% since a record high on July 10th. Since then, the small cap Russell 2000 has outperformed by a remarkable 24 percentage points over the period. And the outperformance, Lisa, continues this morning.
So that's the reason why, and I think you framed this perfectly earlier this morning when you said, ultimately, is this the beginning of a true correction, or is this a wonderful rotation that people have been looking for on the heels of economic strength? It's hard to really understand which. You can make a strong argument for either one.
Most people on Wall Street at the moment, I think, sort of like taking a tally of people on this program, they're saying rotation and broadening out, aren't they? I'm getting many people saying growth scare, with the exception of the economists who run this program saying they need to cut interest rates at the Federal Reserve, and they need to do so fast.
Former New York Fed President Bill Dudley among them, coming out and saying from the data that he has seen, they're at an increasing risk of being too late. This is really the key question. How do stocks respond to downside surprises? It seems like we have been in Goldilocks for long enough that if the Fed is prompted to cut because of weakening data, that'll be a problem for risk assets.
Let's turn to the bond market. In treasuries at the moment, just about unchanged on a 2-year, 10-year and 30-year yield. The 2-year at about 442.86, the 10-year at 423. If you switch at the board, turn a page and get to the foreign exchange market, looking ahead to next week, not just a Federal Reserve decision, but also the BOJ with dollar yen at 154.65. I mentioned the range on dollar yen. Through the week, we've had a 157 handle that I believe was on Monday, Lisa, and we've had a 151 handle, which was the low of yesterday's session. That, for a currency pair like dollar yen, is a pretty wide range.
This used to be a haven bid. This used to be sort of the safe kind of place to go. And suddenly, again, it's trading as though we're an emerging markets currency. A lot of people wondering how much is technical unwinding of popular trades that we've seen in a number of different asset classes, and how much is hinged on this belief the Bank of Japan will raise rates next week. How much could it get reversed if the Bank of Japan does not make a move in next week's meeting?
Jeremy Stretch making that point, saying that this one could whip back in the other direction pretty viciously. That's foreign exchange for you. Under surveillance this morning, some top stories. A new Times Siena poll finding Donald Trump leading Kamala Harris 48% to 47% among likely voters. That's a marked improvement for Democrats when compared to the post-debate poll in early July that showed President Biden behind by 6 percentage points. So there has certainly been a bump in the last few days.
Yeah, although Libby Cantrell says we should just get a cocktail, go to the beach, come back in September, and then we could take a look at the polls. This aspect of it, that nearly 90% of voters said that they approved of Mr. Biden's decision to exit the race, was shocking to me. When have you been able to get Americans to agree, 90% of them, on absolutely anything? To me, this sort of highlights how, in some ways, the bump is coming from relief. Just that there is a different race than that everybody thought that there would be earlier.
I heard someone describe this situation. You know when a CEO leaves a company and the stock rallies, and you always feel bad for the CEO? It has nothing to do with the new CEO. It's just like the old CEO's left and there's a relief rally. That's kind of the polls for the Democrats right now.
Yeah, people looked at the age. It was under 70, and they were very excited.
Yes, bye. Apparently, something like that. Let's get to the data. PCE and personal income and spending data due out in less than an hour. The last key data points going into the Federal Reserve decision next Wednesday. Economists surveyed by Bloomberg expecting both spending and income to grow at a solid clip. Even as core PCE inflation slows to near the Fed's 2% target. That drops at about 8:30 Eastern time. And the Olympics kicking off today in Paris. Train services in France facing disruptions by what authorities have called a coordinated sabotage effort. Just hours before the inauguration ceremony, the head of the National Rail Company, SNCF, saying many trains have to be cancelled and about 800,000 passengers will be affected. This sounds like a nightmare in Paris today.
On so many levels, officials are saying this is less an attack on the Olympic ceremonies and more on just the French people who are all trying to go away from Paris to go on vacation. That there is sort of this feeling that this is a time when people tend to go away. Either way, it sort of raises the specter of how do they maintain security and order at a time where this is supposed to be the first actually regular Olympics. I mean, think about these athletes that previously were in Tokyo during the pandemic, swabbing and being isolated in little rooms. And yeah, a very difficult experience. This was supposed to be sort of the comeback games.
I don't know about you, but I've got absolutely no interest in going to Paris while this is on.
I would like to see, you know, judo and table tennis.
Yeah, okay. We can go to that. We'll get some tickets. We'll drop in and drop out. Let's stick with sports. AC Milan meeting English Premier League club Manchester City in a pre-season friendly at Yankee Stadium tomorrow afternoon. It's the latest push into the United States by the Italian football giants, a market they've seen significant growth in since being bought by New York private equity firm Redbird Capital back in 2022. I'm pleased to say that joining us now to discuss is the AC Milan CEO, Giorgio Ferlani. Giorgio, let's talk about this move. We've seen these friendlies before, AC Milan on tour, playing other teams from the Premier League and elsewhere. It feels like we're getting closer to playing a regular season game in the United States of America. Giorgio, is that true? How close are we to an event like that taking place?
Good morning. Thanks for having me. You're right. We do these tours in the summer regularly to play friendlies against other top teams. Look, there's regulatory challenges in moving abroad and into a different market, domestic league games. But we certainly think if you really want to develop a fan base and you really want to expand your business in the U.S., this would be a critical part. So we will be working with Serie A, our league, and the other regulatory bodies to allow us to.
You've mentioned the bodies you need to work with. Can you just build on that, the obstacles for something like that to take place? Have you had a meeting with Serie A and the regulatory bodies about this already? Have you taken steps to kind of push this forward? How close are we to something like this?
We certainly have discussed it with Serie A. It then needs to be discussed also with UEFA and with FIFA. And the authorities here in the U.S. There have been attempts in the not-so-distant past to play games. La Liga tried to, but it didn't work out. So we'll keep on pushing. It is absolutely important, just in the same way that American leagues have expanded globally by playing regular season games, not just friendlies outside of America. We need to do the same the other way around.
Giorgio, I've got to say, we just saw basically a mini World Cup. We saw the Euros. We saw also Copa America taking place at the same time. Pretty much everyone who I knew on the weekends was watching some of the games as they really got into it. The enthusiasm, though, in the United States for games that were held here was surprisingly not very strong. We didn't hear that much about games that were happening nearby. Have you been disappointed by how some of these games have rolled out at a time when there certainly is more interest, but maybe not in the way that there is in many of the other markets around the world?
Look, I think the ultimate test will be the World Cup in 2026, which will be and that is really the top content together with top games of European continental leagues. And
Giorgio, I think that we're having some trouble with the sound. Let's just try to reestablish that. Then we'll get you back real quick so that we can make sure that we understand everything. But this has actually been part of the issue, John, that people have been talking about, which is essentially we've had these games in the U.S. We're preparing for the World Cup at a time where Copa America wasn't very well kind of advertised in a sort of significant way. And it raises this question, how the U.S. hosts the most important games for the majority of the world in a country that emphasizes other sports.
These clubs have been trying to pivot to the United States for a long, long time. It's amazing to me that the world's #1 sport is football. But if you look at the most valuable franchises on the planet in sport, a lot of them in the top 10 are American sporting franchises, American football, baseball, etc. There's a lot of money here, which is why they want to be here. If you look at the sort of evolution of what Milan have been doing, they're also investing in US talent. So they have the premier soccer star, which is Pulisic, on the roster now. Not a single AC Milan player was in that Italian national team at the Euros this summer. They've invested far more on the US side of things than maybe they have in Italian youth. And we can get Giorgio's opinion on that if we can reestablish the connection, because I'm sure he's got strong thoughts about it. But that might be a criticism of some of the moves that they have made over the last few years.
Yeah, one of their top players is a United States player, which creates this issue. How do you maintain the kind of enthusiasm that some people, even if they're growing up in England but have relatives that are in Italy, can still have if you don't have sort of a homegrown base?
Giorgio, let's come back to you. I'm happy to say that if you are just joining, we are still with the AC Milan CEO, Giorgio Ferlani. Giorgio, I know there was a little bit of a technical connection, but I want to come back to some of the comments we were having around the table. It feels like AC Milan has become more American in the last year or so, and maybe less Italian. The very fact that there wasn't a single AC Milan player on the Italian roster at the Euros this summer, is that a financial decision or a sporting decision?
Very good question. We've definitely become more American. We're owned by an American firm, which is Redbird Capital Partners, which is a leading investor in sports media and entertainment, and we work very closely with them. We've also become more American on the field. So we have, I think you were saying, 2 American players. Our decisions on who to field are entirely sporting. So there isn't a decision on the base of what passport a player has, but it's about how good the player is. Obviously, some players, just by nature of being American, in our case, we have 2 players, including Christian Pulisic, have a certain commercial appeal in the U.S., which is certainly helpful. But we don't drive sporting decisions by passport list.
We were talking, Giorgio, about how the United States is a really expensive market, that there's a lot of money here. And so that's one reason why a lot of people want to come here, is because there are dollars and a lot of eyeballs to come. There are also a lot of dollars coming from the Middle East, and you're going to be facing off with Man City. Giorgio, how open are you to tapping the seemingly endless appetite in the Middle East to own clubs in Europe?
So we tap in the Middle East in a different way, which is on the commercial side. So we've opened an office in Dubai. We're the first European football club to open an office in Dubai. We've had a long-standing 15-plus year relationship with Emirates, the airline. We have other commercial partners in the region, including the Kerzner Group. And so the way we've gone about it is not sort of via, let's say, equity injections, but rather via commercial partnerships.
Giorgio, I just want to squeeze in one final question, and I'll ask this as an AC Milan fan, a lifelong fan like yourself. We both remember the AC Milan of Capello and Sacchi, of Baresi and Maldini. We've both been disappointed with the performance of the team over the last 20 years and the trajectory that we've been on. I remember when the club became a selling club, and I identified that summer when we sold Ibra and we sold Thiago Silva to Paris Saint-Germain. It felt like that was a moment where AC Milan became a club that needed to sell players and couldn't buy that talent anymore. This summer, we've got 2 big players, the left-back Theo Hernandez, and we've got the goalkeeper, Mike Maignan. I want to understand whether that's 2 talents that you need to monetize to fund the rest of the project, or whether AC Milan is back in a position where it can keep world-class talent. Just what is the state of play?
Yeah, so look, on the sporting side, our ambition is to fight for the title in Italy every year and to be competitive in the Champions League. Now, we do this while on the, let's say, other side, running a business that is sustainable. So to give you some facts, 2 years ago was the first year in which AC Milan was profitable, first year in 17 years. And last year was the second year. And I don't think it's ever happened to AC Milan to be profitable in 2 consecutive years. What that translates into is we're not forced to sell players because of capital shortage or cash flow issues. So, picking one word, you say we don't need to sell anyone. So as a fan, I'm telling you, you shouldn't be worried about that.
Well, as a fan, it's good to hear. Giorgio, good luck tomorrow, and hopefully we can catch up soon. Giorgio Fulani there, the AC Milan CEO. Let's turn to some stories elsewhere for you this morning. With your Bloomberg Brief, let's cross over to Danny Berger. Hey, Danny.
Hey, John. Starting with some earnings, Bristol-Myers Squibb jumping in the pre-market trade by nearly 5%. It raised its 2024 profit forecast thanks to demand for its new medicines. Now, there had been questions about future growth of Bristol. Its key drugs face stiff competition and new pricing pressures, but all of its biggest medicines beat sales expectations, while the company said its cost-cutting initiative is starting to pay off. Just over 100 days to go until the election, and a September 10th debate is still on the schedule, but Trump isn't committing just yet. Trump's campaign says it would be inappropriate to commit to the debate until Democrats formally nominate a new candidate. Trump also said he wanted an organization other than ABC News to moderate it. Democrats are poised to virtually nominate Harris and her yet-to-be-named running mate by August 7th. The vice president said yesterday she was ready to debate Donald Trump and accused him of backpedaling from an agreement. SpaceX's Falcon 9 is cleared for takeoff. The uncrewed rocket won approval from U.S. air safety regulators to return to space. On July 11th, a mid-flight failure had grounded the world's most frequently launched rocket. The company, led by Elon Musk, aims to launch as many as 148 flights this year within its Falcon rocket family. SpaceX says it is ready to return to flight as soon as tomorrow. That's your brief. John.
Hey, Danny, thank you. More from Danny in about 30 minutes. Up next on the program, a turbulent summer travel season.
We've seen this theme of transportation stocks missing, whether it's airlines, American Airlines. To us, that flies in the face of this recent rotation into small caps and risk-taking.
That conversation up next, live from New York. You're watching Bloomberg Surveillance.
Names in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
I especially am afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself. Yeah. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Or other authorities.
Could face bigger challenges next.
Fed was going to keep rate World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Equities look like this on the S&P 500, firmer by 0.8%. We're picking up here. Elsewhere, the outperformance on the small caps once again this morning going into the opening bell. In the bond market, yields just about unchanged. The 10-year 423.48. Under surveillance this morning, a turbulent summer travel season.
We've seen this theme of transportation stocks missing, whether it's airlines, American Airlines, Ford today, Tesla recently, and even UPS. So companies with heavy cyclical exposure to the economy have been disappointing, and to us that flies in the face of this recent rotation into small caps and risk-taking.
So here's the latest. It's been super difficult for the airlines. American Airlines reporting disappointing earnings, slashing its profit outlook after overestimating demand for domestic travel. This as Delta returns to normal operations following last Friday's global tech outage that led to thousands of cancelled flights. Joining us to discuss this industry, Sheila Kahulu of Jefferies. Sheila, it's good to see you.
Thank you for having me.
Where do you want to start? Delta come out and say things aren't great. And then United come out and say the same things. And I'm thinking, well, we're going into American now. Surely we've lowered the bar enough and the market's looking for this. And then American come out and say things are pretty bad and the stock craters. Have we not lowered the bar enough for these airlines still?
It keeps getting worse. Air France pre-announced negatively yesterday on the Paris Olympics impact. Air Canada, Lufthansa cut EBIT by 50%. So it keeps getting worse, especially in the Atlantic yields. There's more competition, and that's what's been holding up on the international side. But American and Southwest really have both had strategic missteps. American realigned its corporate strategy, and it decided to go direct, and it really missed out on revenue points. So they're going back into that, adding sales force, which they've cut over the last 2 years. Southwest is Southwest. They've had some strategic issues. And what they're doing, yesterday they said they're going to add premium seats. So instead of an aircraft with 175 seats. They're going to go to 160, which is like the Delta and United average, add extra rows of legroom, and change their onboarding strategy a bit.
It's Southwest welcome to the 2020s, like 4 years late.
Yeah.
What do you make of the timing of these executions from both American and Southwest?
I think they're realizing they're losing out on market share, and their yields are worse than everybody else, so something's got to give. It's just a matter of how quickly can they do it. I think American can do it faster. You know, as a corporate booker, I don't know how quickly, I don't know where Jeffries is booking, you know, my American Airlines flight to Heathrow at this week. So I think it's easier to regain that. Southwest is really shifting its strategy with assigned seats. And don't forget, they make about $1 billion of revenue out of their $24 billion of revenue from early board booking. So they could lose that revenue. So it's unclear how quickly Southwest could actually take share back.
So this is totally off script, but you mentioned Air France, and you talked about how the bookings have actually gone down because of the Olympics. Yeah. I don't get this. They're not the first to say this. We've talked to others who also say that actually travel is going down because of the Olympics. Isn't it supposed to be the opposite? Isn't
that's what I thought too.
Of cities becoming the host cities for Olympics, being that it increases traffic?
Yeah, and Ed Bastian at Delta told us otherwise. Delta has a Paris hub, so that's why it's more impacted than everybody else. But apparently no one's going to Paris this summer, and even if they are, they're not doing multi-leg flights. So they called out about $100 million in impact. Air France called out a bigger impact. I think it's a one-time thing we could look through, but yeah, I would assume the opposite as well.
There's a question right now, not just about execution and profitability of some of these airlines, but also how do they maintain morale at a time when there are some snafus? We're talking about Delta and the issue around CrowdStrike and the fact that some of the employees didn't really feel like they knew who to call. Now, United Air is requiring a doctor's note to call out sick for pilots, and that's now being reviewed by federal officials. I'm just wondering, is that a problem at a time where execution kind of depends on these people?
No, just listen to an airline earnings call. They sound great. You know, peak revenue, all-time high revenues. You wouldn't know anything is wrong with an airline by listening to an airline earnings call. Things sound absolutely lovely. You know, revenues are at all-time highs. It's just
Where's the disconnect here?
I think that's, you know, you have to look at profitability and what profitability looks like, what cash levels look like. American and Southwest are draining their cash balances. American won't be able to delever. Southwest keeps buying more planes. But I think, you know, in any industry, airlines, pilots are you know, have a great morale, so the flight attendants, and they also have contracts that they just put into place. So most of the airlines have their contracts in place. American has another cost headwind coming up. It's going to look to ratify its flight attendant contract, so that's going to be a headwind for the second half of this year and into 25.
You really don't sound impressed with the way that Southwest is run. Is that fair to say?
I think running an airline is an extremely hard job because you book and ship right away. Prices swing 10%, and your 1 point of price is 10% of EBITDA. So you could really mess up an airline very, very quickly. So I don't envy those who have to run an airline.
You have sympathy with them, but is there something about they're running their business versus, say, Delta is that means they're performing this poorly?
I think if you focus on premium, it's a more steady base, and you have that pricing cushion. So, you know, any mistake in the domestic markets, if you put too much capacity, you're making up for it in your international side where you have 20% operating margins. So I think that's where they have a little bit of cushion with Delta and United. And they're just bigger. They have brand loyalty. They have the credit card. They have their Delta Tech Ops, so that's their maintenance business. That if they spun that off, that would probably be worth $10 to $15 billion. So they have a lot of. I mean, that just tells you what Delta is worth. If you strip away Sky Miles, you put it at a Visa multiple, and you looked at their Delta Tech Ops business, it would mean Delta Airlines as an airline is not worth anything.
Lisa's asked this question a million times. They sound like credit card companies now. Why don't they just say that they are credit companies?
They try.
Would they be better off?
I think they're really pitching that, and you saw that with United. It took out the leverage that was associated with its credit card business to essentially unencumber the asset. Granted, it was an 11%, note, so it was saving them a lot of interest to put away that debt, retire that debt, but still.
From a broader perspective, just sort of zooming out, we were speaking with Sucharita earlier of Forrester Research, and she was saying that on the margins, you are seeing some pushback by even the higher-end consumers. Maybe this has to do with China, LVMH. We saw Gucci, really underperforming. Are we seeing the same kind of spending patterns at the highest end of the cabin, which really had been sort of the mainstay for profitability for a lot of these companies?
I think that's what everybody's worried about with airlines, right? They're not giving them the credit for the premium offering, and we cover the business manufacturers, Textron and Gulfstream. They both reported book-to-bills of 1.0, but you didn't see an acceleration in orders for the biz jets. So is that hitting the high end? You know, you're seeing flight utilization for business jets up versus 2019 levels, 20%, but year over year, they were down 1%. So is this kind of a leveling out of even the high end, which the consumer brands would tell you it is?
Sheila, you've been busy, that's for sure, over the last week. Sheila Kohli there of Jefferies. Think about the changes we've seen in the last week. American, another disappointment. Southwest, a change in policy. Delta, struggling to recover from the issues that we were talking about in this show a week ago.
You asked the right question about Southwest. What took them so long? I mean, at a certain point, I understand it's the culture, and I'm sure that they're getting a lot of backlash from people saying, come on, now you're going to join everybody trying to bifurcate people according to how much they're willing to spend. And Southwest would say, yeah, because we need to make money. And guess what? That's how people do it.
Still the most confusing one for me out of all the airlines in the States. You know which one I'm going to name? JetBlue. I don't understand JetBlue. They have got a serious branding problem. If you go on a JetBlue flight, the customer service is absolutely phenomenal. You and I both shared a flight, transatlantic to London, fantastic flight, flew business with work, thank you, with work, and it was fantastic. It was brilliant. It was up there with the likes of Delta, with the likes of American, and I just don't feel like that they market that well enough in any way, shape, or form.
Because they want to cater to families. Look at their routes going down to Florida, going down to the islands. That's the sort of, you know, you go and people put on hats and they're with their families. They're excited. It sounds really nice.
But they sound budget when they're not. Do you know what I mean? They're sort of like, you know.
It's like big box stores trying to look cheap.
Yeah, I don't. Anyway, coming up, less on JetBlue. Less on AC Milan even. Up next on the programme, Sam Stilwell of CFRA.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
From our our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Throughout this earnings season, there is absolutely zero tolerance for anything that even smells of weakness.
Those mega cap techs have unbelievable return on equity. But nonetheless, trees don't grow to the sky. These things can revert really quickly.
You have lofty expectations, you have lofty valuations, investors will continue this unwind trade.
The concerns are valid. I do think there's frothiness in parts of the ecosystem.
The earnings season so far has still been really, really solid, and that speaks for other sectors really to participate as well.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
90 minutes away from the opening bell and about 30 minutes away from some economic data in America. Let's turn to the price action. Equity futures on the S&P 500 firmer by 0.9%. The Nasdaq bouncing back by a little more than 1 full percentage point, and the Russell of small caps flying once again, outperforming. We're higher by 1.7%. The only question that matters around this table at the moment: what is the state of the US consumer? Andrew Honhorst of Citi saying this: continued solid consumption will depend on the labour market. And we're all looking ahead to that payrolls report next Friday. This is what him and the team are looking for: 150K on payrolls, but they're looking for the unemployment rate, Lisa, to climb back up to 4.2%.
Potentially triggering the SOM rule, which we heard from Bill Dudley is one of the key reasons why he feels like there is renewed urgency for the Federal Reserve to cut rates, even though Claudia Sahm herself has said it's just, one benchmark. You shouldn't really take it as necessarily gospel. I will say, even heading before the jobs report, we get personal income and spending in about a half hour. And really, I feel like we got to bring back toxic brew, because it feels like with thin liquidity and this idea of, uncertainty around the trajectory of the economy, one bad print one way or another could really cause a pretty disproportional response.
It's been a while since we talked about toxic brew.
I think it's time to start, reflecting on it.
Let's talk about what's in the brew. What's in the brew right now?
We've got a situation with earnings that are inconsistent across the board, some winning, some losing. Maybe it's execution, maybe it's consumers pushing back a little bit more. You have unemployment rate that's creeping higher, albeit at a normalizing pace. We have claims that are inconsistent, but still just nudging up. And then you have this situation where if you look at financial conditions, they are tightening. They're at some of the tightest paces just based on the recent sell-off so far this year, but still companies are able to borrow. Capital markets are open and credit spreads are tight. This is a potentially confusing brew that could easily turn into a toxic brew with potentially certain negative prints.
It makes it really difficult to answer the question that we asked 3 times to 3 different guests yesterday. Is it a rotation, a broadening out, or a growth scare? And when you point to credit spreads and say they're tight, that says things are okay. That supports the idea this is just a rally that's broadening out away from big tech. When you see what's developing in rates markets at the front end of the curve, that rally off the back of the prospect of maybe getting some bad data at some point in our future, didn't get it yesterday, maybe on Friday, you start to wonder if it's a growth scare. And that's going to be the debate we have right the way through the summer into Jackson Hole, regardless of what the Fed says next week.
And here's the rub. We don't really have the answer. I mean, even Michael Hartnett, who has had a bearish tilt for quite a while, has basically said we're one bad data print away from big tech, leading the whole index lower. When people talk about short term, a lot of people say that there could potentially be momentum in some of the sell-off, albeit it won't necessarily be a lasting sort of situation. Key thing is people don't have visibility. So how do you have conviction? How do you have anything other than tactical at a time where there's very little visibility?
We haven't talked about toxic brew for a long, long time. Throwback.
I know. I think it's not quite toxic, but I think that it's definitely a brew. It's not,
all of that.
Yeah, I think it's
toxic brew, tank chasers. As for the tank chasers, by the way, TK joining us on the Fed show. next Wednesday afternoon. So look out for that. Sort of reunited for one special edition of the Federal Reserve decision and then back again together for the Jackson Hole meeting at the end of August. Let's get to this. Let's get to the price action. In the equity market right now on the S&P 500, firmer by 0.8 to 0.9, call it 0.85 on the S&P. In the bond market, the 10-year 423.87. In foreign exchange, the euro just a little bit stronger, 108.62. Coming up this hour, we'll catch up with Sam Stovall of CFRA as the equity bull market hits a bit of a wall. Republican Senator Bill Hagerty as D.C. tries to predict a Trump 2.0 cabinet, and Mark Zandi of Moody's Analytics on why too high for too long is starting to crack the U.S. economy. We begin with the big issue, the tech-led rout pausing as investors await PCE data out in just under 30 minutes' time. Last week's rotation continuing as investors confront disappointing earnings. Sam Stovall of CFRA has this to say. The lofty initial expectations for second quarter earnings growth have caused some mega cap high flyers to fail to clear this elevated bar, causing investors to wonder if other mega cap disappointments should be anticipated. Sam joins us now for more. So Sam, let's get to the calendar. Let's go through next week. Microsoft, Amazon, Meta, Apple. Do you think we're set up for some disappointment here?
Hey, Jonathan. Well, certainly next week, 40% of the cap weighting of the S&P 500 tech sector will be reporting earnings. Even though expectations are that we've seen a better movement in earnings for the technology sector now at about 17%, up from 16% and change, I think, yeah, investors will definitely be paying a lot of attention to what is said and implied with these upcoming earnings. The chip companies typically do have some challenges when it comes to third quarter areas. And our feeling is that, while there could be some stumbling, we are maintaining our overweight recommendation on tech, mainly because companies will soon be looking at 2026 estimates and pretty much ignoring what they are hearing right now in 2024.
Sam, let's take the earnings so far this week. Let's pick out one name. Let's talk about the likes of Alphabet. And we can think about how the way the market responded to what Alphabet had to say. Based on that, what are investors in the mood to reward and what are investors in the mood to punish? And I think that's something really interesting that we've got to try and answer in anticipation of the earnings next week, because it felt like investors were in the mood to punish excess investment out of Alphabet, whatever you would call excess. I want to understand how that might set us up for next week, Sam. How do you think about that?
Well, I think what that implies is that investors are really only looking short term, because the investments that Alphabet was making is obviously for 2025, 2026, which is the cause for our optimism longer term. But in the near term, investors are basically saying that recently we had tech selling at a 78% premium to its average 20-year PE ratio, the market itself at a 38% premium, and the relative strength between the cap-weighted tech and equal-weighted tech sectors were back to where we were during the dot-com bubble. So I think that investors are saying if there's any hint of disappointment, I'd rather sell first and ask questions later.
Sam, I guess another way of putting this together is how low is the bar right now heading into next week for some of these earnings? After the sell-off we've seen, a true correction down about 13% since the July 10th record highs that we saw in the Magnificent Seven stocks. How much do you anticipate that any additional disappointment or even just not superlative type of results will provoke some pretty significant selling in addition to what we've already seen?
Well, I'm looking at history. I would tend to say that we are due for a double-digit decline in the order of 10 to 13%, primarily because of the advance that we experienced in the first quarter, as well as for the first half, and as I had mentioned in terms of the valuations. However, I do think it'll be contained to a correction, not the beginning of a new bear market, and would probably end up representing a good buying opportunity as we approach the fourth quarter of this election year. Let me also mention that when it comes to elections, there's the possibility of a red wave. And whenever we have had waves in the past, we've had 3 Republican waves since World War II, 7 Democratic waves since World War II, that has added a percentage and a half to the average return in the first year of a new administration.
So let me get this right, Stam. A lot of people are saying that a red wave, or a blue wave, but in this case, a red wave, would actually cause inflation to go up and could become a problem for the bond market. You see it as the opposite, that actually any kind of dominance in Congress would actually lead to greater returns in equity markets. Is that correct?
That's what has historically happened, but obviously it's going to depend on what the new administration puts forth. If we do see, in a sense, very high walls in terms of tariffs and whatnot across the globe, then yes, that will end up being very restrictive, would be a hurt to our exports, would certainly smell of, or have the sniff test of the Smoot-Hawley tariff back in the early 1930s, which restricted global trade. So I don't think that would be a very good thing, and I believe that those who end up being in power would be very much aware of that.
Sam, just taking a step back, it seems like you're still pretty constructive on the overall backdrop for the U.S. economy. It doesn't seem like you're sort of expecting a major fall off the cliff type of moment. What would you have to see to change that view for some of the growth worries to become a true growth scare for you?
Well, as I had mentioned, the valuations were stretched, in my opinion, 78% premium for tech. Now it's down to about 64%. So some more slight downward rotation for tech, I think, would be encouraging. I think if we get a softer than expected PCE reading this morning, that could also help talk the market off the ledge. And because we've been seeing an improvement in the rotation beneath the surface, our Lowry technical analysis arm has been showing an encouraging amount of supply-demand indicators that they monitor to say that while a short-term pullback could certainly be in order, that they are looking at that as a good buying opportunity.
Let's see what we get in 20 minutes. Hey, Sam, thank you, sir. Sam Stovall there of CFRA. This from Ian Lincoln of BMO. He says, happy anniversary. I opened up the email thinking, what on earth is he talking about? And then he said it was exactly 1 year ago, July 26, 2023, that the FOMC brought Fed funds to this cycle's terminal rate of 525 to 550. Also the anniversary of the Draghi whatever it takes bumblebee speech.
Yeah.
Back in 2012. We're going back a long time, aren't we? 12 years.
So at this point, I'm wondering how long beyond this are we going to see a difference in the Fed funds rate? And I guess a lot of people are expecting it is not going to be next week, but can you imagine if it were a full, 1 year kind of pathway?
They cut rates?
Really, yeah, and then it would be this sort of very...
Just perfect.
Yeah, it would have this sort of, arc
I don't think that's how other
narrative
people
arc.
think about this. I was just reflecting on the Draghi speech, the bumblebee speech back in 2012. I know people who were in the room, and the people in the room at the time didn't feel like it was a big deal. That's what was amazing about that speech. People at the time didn't feel like it was a big deal. And then it was like the days afterwards that we started to put together, hang on a minute, is he going to come together with some big plan here that's going to turn around the whole story? Lifetime ago. Can't believe that time has gone by as quickly as it has. 12 years. Let's give you an update on news elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Shares of 3M up some 6.6% in the pre-market trade this morning. It reported second quarter net sales that beat estimates. It also raised its full-year profit forecast. It's the first earnings report since Bill Brown took over as CEO. Brown saying accelerating sales growth is a priority and that he wants to get there by increasing the pace of new product development. Now, as the Olympics are set to kick off in Paris later today, French authorities are contending with what they're calling malicious acts targeting the nation's high-speed rail systems. Fires were set at several infrastructure hubs along the rail system. Officials say people were seen fleeing the sites in vans. Eurostar says its services to London and Brussels have been impacted, with several trains delayed or canceled. The National Rail Company says it will have to repair its network cable by cable. Vice President Kamala Harris has picked up another key Democratic endorsement, Barack and Michelle Obama. Harris earlier this week secured enough pledged delegates to clinch the nomination. It capped a whirlwind week that saw Democrats coalesce around her as President Biden decided to end his candidacy. Biden quickly endorsed Harris, but Barack Obama held back. A person familiar with his thinking telling Bloomberg that he first wanted to give the party time to unite behind a candidate. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the programme, the morning calls, plus we'll catch up with the Republican Senator Bill Hagerty on possible Trump 2.0 policy initiatives. That conversation up next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Live from New York, counting it down to the opening bell with equity futures positive here by 0.8%. Yields unchanged on a 10-year, 424.26. The opening bell about 1 hour and 14 minutes away. Let's get you some morning calls. First up, Evercore upgrading CBRE to outperform with a 123 price target. The analyst noting the real estate services firm appears to be turning a corner thanks to upbeat second quarter earnings. The second call from Phillips Securities downgrading Tesla to sell and lowering its price target to 135. The analyst seeing further margin headwinds due to soft pricing and EU tariffs on China exports. And your third and final call from Guggenheim, lowering its price target on Chipotle to $54, maintaining a neutral rating. The firm lowering its 24 and 25 EPS estimates for the fast casual chain, seeing softer margins offsetting modestly higher same-store sales. That stock just about positive by 0.7%. Let's turn to the election. Sunday marking 100 days until voters head to the polls. If re-elected, former President Donald Trump is widely expected to appoint a so-called Capitol Hill cabinet, which could be full of congressmen. That includes Republican Senator Bill Hagerty, who is being floated as a potential pick for Treasury Secretary. The senator joins us now for more. Senator, it's wonderful to catch up with you, sir. I understand you are attending the cryptocurrency industry conference in Nashville, and we'll touch on that in just a moment. I just want to gauge where you sit on certain issues in foreign exchange, Senator, given our conversation with the former president of Bloomberg Business Week in the last week. The former president, Donald Trump, said this about the currency. He says the United States has a currency problem. I understand we have a technical issue with the senator. Can the senator hear me still, even if we can't see him and the shot is frozen? Can you confirm that? We can't hear him either. Okay, so we've got a bit of a technical issue. We'll try and confirm a re-established connection in just a moment. The conversation I wanted to have was around foreign exchange, Lisa, and the first question would have been, and I'll share that with you right now, ultimately, if we've got a currency problem, what can they do about it in Treasury?
Yeah, especially at a time when ultimately this is about the Bank of Japan holding rates incredibly low and the U.S. having a strong economy. Potentially, how do you further the idea of a weaker dollar if you do pursue some of the policies that Donald Trump has talked about, including higher tariffs, including reducing certain immigration?
Deutsche Bank have this to say: tariffs and their associated stronger implications for the dollar are significantly more likely to be the dominant market outcome than policies to pursue a weaker dollar. And this is the issue at play here, almost a contradiction. You identify a problem you think is the currency, ultimately it's too strong, but you also propose some policies that could strengthen it in the minds of a lot of people that come on this program.
Part of the problem to really understand where the former president is sort of thinking is if you do have two contradictory policies, which is more important? Is the idea of a weaker dollar and potentially more exports more important, or is the idea of putting up some gates for products coming in here from, say, China and potentially reducing immigration?
I'm happy to say we've re-established that connection with the senator, and hopefully we can get across to him now. Senator Hagerty, do you hear me okay? No. He does not hear me okay. I think we're going to let this one go, because I don't think we can establish this connection at all. Senator Hagerty there on the latest from the cryptocurrency conference in Nashville. We went through some of the prices to attend some of this fundraiser. I shared them with you a little bit earlier. I think it's worth going over again. Donald Trump's going to be there, and he's inviting supporters in a private fundraising event to Nashville on July 27th. And it includes this: asking $844,600 for a seat at a round table. Donors can also get a photo, a snap with the presidential candidate for $60,000 per person and $100,000 per couple. That's some real money they could be raising this weekend at a time when we've seen the figures coming out of the campaign for Kamala Harris, or Act Blue, to be more precise. Some real numbers since Sunday.
It raises a question about this particular forum, right, and sort of the connection that it has. Crypto assets in particular, sort of hot topic for a long time and then took a little bit more of a back seat. The idea of where the role comes into play and kind of where government oversight comes. I mean, this to me is compelling to me, this idea of, are they looking for less regulation? What is the purpose of crypto assets going forward? And, you know, I mean, I guess that it's just sort of an interesting moment for that to be in the fore.
There is a kind interpretation and a less kind interpretation. The kind interpretation, to your point, is that they want some regulation. The regulation they've been asking for, they want things to become more predictable, they want to build this out, they think it could be beneficial to the broader economy. The less kind interpretation is that the cryptocurrency world has identified an administration that could introduce some policies that destabilize the US dollar and would be advantageous to the price of Bitcoin. So, like all things to do with politics, pick your poison. Is it the kind interpretation of what's happening here, or the less kind interpretation?
And I will let everybody make their decision. When you zoom out, there is this real question, and I think that we've seen this again and again, where there isn't a clear candidate right now for president that is clearly business friendly. It is unclear who the business-friendly administration actually is. I think that we have to keep asking that, and I think that actually, I hope that we can at some point talk to Senator Bill Hagerty, maybe not today, but at some point get him back on, because he has been of the business world, and I have this real fundamental question of, especially at a time of protectionism on both sides of the aisle, especially at a time when you have a real fraught national security moment, how do you become the party for business? What does that mean? Sometimes it can just be consistencies of policies. Does it mean the idea of putting up gates or not? We talked to Stellantis yesterday saying that actually tariffs hurt their business, even if they reduce competition in the short run from China. So a lot of real questions around some of the traditional associations in the political parties and how they're really changing.
When we say the party of business, my response would be, what business? If we're talking about big tech, not the party of big tech. If we're talking about small business, David Malpass, former World Bank president, in the running potentially for a role in the next administration under Donald Trump, around this table talking up what? Small business. They want to help small business. It's not about being pro big tech. So the party of business, but certainly not big business anymore. And I think that's the populist bent in this party that's pushed them in that direction.
Yeah, it's a good point. And I wonder how much it's small business versus large, or whether it's specific industries that have certain projects that are positive or negative for certain bases. Either way, I think that when you talk to a lot of politicians, they're saying, pick one, pick a policy and stick with it, because if you want to make plans, you have to be able to count on a landscape that is not shifting at every administration every couple of years. I do wonder how much, though, that really has changed the tenor of some of the conversations of bank CEOs, of industrial CEOs who go to the White House, who speak with the former President Trump about what policies they'd like to see.
Let's make some plans on this program. In about 7 minutes' time, we get some economic data. Let's go through it. Personal income. We'll get PCE, then a little bit later at 10 a.m. Eastern Time, we get University of Michigan sentiment numbers as well. That sets us up for the last big slate of data before we go into next week when we get a Federal Reserve decision. And 2 days after that Fed meeting, a payrolls report in the United States of America. The estimate on our side of things for payrolls in our survey, 175,000 is the median estimate in our survey. The previous number is about 206. Into the numbers we get in about 6 minutes' time. Let's turn to the price action and start with equity futures. On the S&P 500, we look like this. We're positive by 0.8%. On the Nasdaq 100, up by 1.1%. On the Russell of small caps, monster outperformance once again this morning, higher by 1.4%. If you look at the price action, the outperformance we've seen over the last few weeks, and I've gone over this stat a million times, I think it's worth going over again from Jim Reed at Deutsche Bank, 24 percentage points of outperformance on the Russell 2000 versus the Mag 7 since the record high back on July 10th. Lisa, that's mega outperformance.
Yeah, and it comes after a mega underperformance earlier this year. This is the reason why the main question for so many people has been, is what we're seeing right now in markets really good and actually shows that a healing economy is going to let some of the other companies other than big tech really benefit? Or does this begin a sort of downward spiral that at least can cause a deeper correction? The answer has been unclear.
Mike McKee dropping by the studio ahead of this break in economic data. Mike, we've had some data already this week. GDP was better, jobless claims a little bit lower. What are you looking for from the numbers later this morning?
Better. It's a good way to put it. We're expecting a slight decline from the PCE inflation numbers, although this is going to be a 3-digit issue here today because there are some questions about whether they might come in stronger than anticipated because of rounding effects. You know, so it's a 0.1% change for the PCE price index, but if it's 1.6, then it's going to round up to 2. And that might worry some people, but in general, we're expecting overall inflation to be down and spending to be reasonably good because we saw that in the GDP report yesterday.
In 30 seconds, was yesterday's GDP print as good as it was, as people thought that it was on its face?
It's better than I think some people are looking at because a lot of it was based on consumption, and that's what the Fed wants to see. People were not necessarily pulling back. They're spending a little less, but it looks reasonably good. So overall, not too bad. And the good news today is this is an 8:30 number, and everybody can head out to the beach or whatever relatively early today.
That is the good news, unless you're hanging out for you, Mitch.
Well,
are you hanging out for you, Mitch?
Yeah, I am hanging out.
Okay, good for you.
But after that, we'll go. And then we can go home and, you know.
Some of us are not hanging out for you, Mitch. All right, breaking economic data up next. We'll catch up with Mark Zandi at Moody's. Mike McKee will break this down. That's all coming up next on the show.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Economic data seconds away, with equity futures on the S&P positive by 0.8% and the Nasdaq up by a little more than 1 full percentage point. On the Russell, positive by 1.4. That's where your outperformance has been. It's where it is this morning. In the bond market, a 2-year, 10-year, 30-year shaping up as follows. The 2-year yield higher by a basis point, 4.43, call it 4.44. And in the bond market on a 10-year, just about unchanged at 4.23, 4.22.70. With that economic data, Mike McKee around the table. Mike McKee, what have we got?
We've got a little bit less than anticipated in terms of personal income, and spending comes in as forecast. Personal income up 0.2 and personal spending up 0.3. Now, the numbers that everybody really wants to see, PCE price index comes in spot on, hits on the screws, 0.1% for the increase in June, same as forecast. The PCE year over year, 2.5%. That is as forecast and down 0.1 from last month. And then the core comes in 0.2 as forecast and 2.6%, which is a little bit higher than the core forecast for the year over year, which was 2.5. So that's probably where that rounding error comes in a little bit. But income spending were also revised a little bit lower. Well, income was revised lower for the month of May, and spending revised higher for the month of May. So at this point, you've got a reasonable incomes, good spending numbers, and prices continuing to inch down. They're not going really fast, and that's the thing that a lot of people are hoping for, but maybe this is enough to get the Fed going.
If we just take a step back and think about what the last 24 hours has looked like, Mike, before the economic data yesterday, a hot GDP, and a decent jobless claims relative to expectations, there were these massive calls to get a move on at the Federal Reserve. And we can go through these calls piece by piece. Mohamed El-Erian came on this program a month or so ago and said, I think they need to move in July. There's a risk here that the labor market weakens and weakens quickly, and they need to get ahead of all of that. Yana Hatsis of Goldman Sachs asked the question as well, why wait? Bill Dudley, the former New York Fed president, wrote an opinion column on Bloomberg Opinion saying, I've changed my view based on the labor market. They need to get a move on. I remember you saying yesterday when the jobless claims numbers dropped, it's almost like for the Federal Reserve, what do you want us to do? The numbers look okay. Yeah. Where does that argument stack up now? How does it stack up going into this meeting next week?
This doesn't really change anything. The spending numbers aren't strong enough to say that we're not going to get rid of inflation because the economy is overheating. The income numbers show a little bit of a decline, and we'll have to look at what the overall composition of that is. I've just got the numbers here. Wages and salaries up 0.3. That's down from a 0.6 gain in the month of May. So a little bit better there in terms of what you're looking for in inflation. Savings rate 3.4 from 3.5. You know, this is all not a collapsing economy that you need to immediately rescue. It is one that is slowing down.
And we can see not much of a reaction in markets, just a little bit on the margins. Yield just a touch lower, but coming back, and John will go through all of that. But I'm looking right now at this data, and it points to this idea, slowing, not slow, right? But the stickiness in core PCE, does that make anyone take pause? I mean, there's this question of, can we really write off the idea of a resurgence in inflation if you do have certain goods inflation aspects coming up, just as services inflation goes down?
Well, services inflation is still hanging in there is the problem, and goods inflation has fallen quite a bit, but everything is moving down slowly. And we're got to be at a point sometime soon, given that Jay Powell and others at the Fed have said we're going to have to start lowering rates before we get to the 2% target. I mean, we're in range now. He has said 2.5.
You've made the point also, Mike, that you think to some extent this market's already doing the work for them, that all they need to do next week is just sort of validate what the market's priced for. Is that fair?
I think that's the case. If they suggest strongly in the statement or Jay Powell's news conference that we're going to see a September rate cut, then their market's going to price that in, and they're going to get the effect of a rate cut in July.
Going into the next week, we have a lot coming up. We've got, of course, the FOMC meeting. We also have the Treasury refunding announcement, and we've got some of the tech earnings capped off with the jobs report on Friday. From the Fed's perspective, how much are they watching some of those pivotal earnings? given that the signals from corporate executives have been some of the most forward-looking indicators that a lot of economists have hooked into?
Well, they'll pay a lot of attention to it, and they're always talking to the CEOs in their districts all the time, and the Board of Governors is out talking to people. So they have a pretty good idea of what these executives are thinking. And obviously, with the Fed, it's going to be the same as it is with investors. You're going to be looking at what the forward-looking forecast is for earnings at these companies. And then if anybody says anything about layoffs or anything like that, right now, earnings seem to be coming in okay, given the situation. And the forecasts for 2025 are pretty good. So the Fed is not overly worried about recession at this point. But I will say one thing, and that is I don't want to dismiss the idea of this slowing economy too much, because we don't get the jobs report until next Friday. And if that shows 4.2%, then you trigger the Somme rule, and it scares investors, and it scares the horses, and then it maybe scares the Fed. So we have to wait and see how that turns out.
Citi thinks we hit 4.2 next week. I'm far more interested in how the market responds to this than the Federal Reserve, because the Federal Reserve knows we're close to it, and they don't seem too worried about it. Bill Dudley, the former New York Fed president, suggests that they should be. I just wonder if the market sees that, given how well-known that rule has become, particularly over the last few years, Lisa, that people begin to price in what they believe will be, with certainty in their minds, a recession.
What I find interesting is that for most of this year, the volatility was in the bond market. We saw pretty massive fluctuations. Over the past couple of weeks, yes, we've seen some real moves in the bond market, but the volatility has been in the stock market. How much will the stock market, will risk assets actually respond to a downside surprise or in that jobs report or a 4.2% unemployment report, much more than even the bond market, which is already pricing in a good deal of rate cutting?
Next to no news yesterday on NVIDIA. The range down by 6.9% of the lows, the highs positive 2%. That's a massive range on one of the biggest companies on the planet. Talk about volatility.
And we've seen it index-wide, and that, I think, is sort of different. We've seen it in specific stocks, but not index-wide in the same kind of way as we have over the past couple of weeks.
Let's get to the price action, and then we'll build on this conversation on the economic side of things. Equity futures going into the opening bell in about an hour from now, positive by 0.8, on the Nasdaq up by 1%, on a Russell up by 1.4. In the bond market, we look a little something like this. Yields lower by 2 basis points on a 2-year, 440, down about 2 as well on a 10-year at 421.72. Nothing too scary in this economic data this morning. To discuss, I'm pleased to say, a good friend of this program over the years, Mark Zandi at Moody's Analytics, joins us now for more. Mark, you think maybe we've been too high for too long in this Federal Reserve. How would you like to see this conversation change next Wednesday?
Well, I mean, at this point, Jonathan, I think September is when the Fed wants to cut and when they will cut. So I just think they're going to reaffirm that with this meeting and press conference and everything else that goes around it. So I think it's all about just confirming current market expectations. And you know, investors, you probably know better than I, but I think there's a close to 100% probability to expect a September rate cut. Today's data is consistent with that, and I think that's the language we're going to hear next week from the Fed, that they're just going to, you know, cement that expectation.
Mark, the Fed believes they've got time, and we had this exchange with Bill Dudley. I'm sure you read his piece on Bloomberg Opinion earlier this week. The former New York Fed president suggesting that maybe they're miscalculating how much time they have, taking too much comfort away from what's developing in the labor market. As you look across the labor market, I just want to understand what's on your dashboard right now, Mark. What is concerning you? What stands out? What's sort of flashing brightly for you?
Well, I agree with Bill. You know, I think the Fed should, I think the Fed should have been cutting earlier this year. You know, reason being that they've achieved their objectives. The objective is full employment, you know, check, 4.1% unemployment rate, and low and stable inflation. And I say check. I mean, the PCE inflation is 2.5%, within spitting distance of their target, and everything is headed in the right direction. And, you know, we've been reduced to going to the second and third significant digit here. But if you do that with today's numbers, you're right on target. And the other thing I'd say is, if you exclude the cost of the implicit cost of home ownership, which I think you should do, there's growing evidence that is not really helpful in setting monetary policy. The PCE deflator is at 2% or below, and has, on a year-over-year basis, has been there for more than a year. So you got to ask yourself the question, well, you know, why a 5.5% funds rate target when you've achieved your objectives? And I'd say, you know, if you're saying the counter is, well, nothing's going wrong. Well, really, you're going to wait till something goes wrong before you start cutting rates? Isn't that too late? It's in the job market, what's going on in the financial system. It just strongly argues to me that the Fed should be cutting rates. But having said all of that, it looks like September. I'll take it.
Mark, one thing that we were talking to with Bill Dudley was why now? What triggered this shift in view that it is time to cut rates in possibly even next week, given that the economy is still hanging in there? And you're saying, well, why wait? Because you see enough signs of weakening. You point to something else, and that's the downward revisions in the labor market for prior months, that concerns you. Why is that important?
Well, Lisa, it's the plethora of labor market data suggests that it's downshifting in a pretty meaningful way. The downward revisions to previous payroll employment reports is consistent with that, but there's a lot of other evidence. I mean, hours worked are down, hiring rates are down, quit rates are down, temp jobs are down. The only thing that's kind of hanging in there really well is layoffs. They feel like they're ticking up a little bit, but they're low, and that's great. But we don't have a really good theory as to why businesses are so reluctant to lay off. We've got theories, labor hoarding kind of theories, but they feel rather tenuous to me. And as we saw in the tech sector a little over a year ago, high-flying companies that are hiring boats loaded of people can turn around pretty quickly and start laying off workers pretty quickly. So, I think things can change very fast, and once they change, it's too late. It's too late. The other thing, at least I'd say, is it's not only about the labor market; it's about the financial system. The financial system is under a lot of pressure. The yield curve, the difference between short and long rates, is still inverted, and that's a very uncomfortable place for banks and other non-bank financial institutions. You throw in weakening credit quality, slower loan growth because of the tightening and underwriting in the wake of last year's banking crisis, higher regulatory costs. The operating environment is pretty tough, and so something could break in the financial system. And as we saw from the crisis a little over a year ago, that can happen also very quickly. So why take that chance?
You're talking about things changing very fast and the potential financial pressures. We're seeing a lot of volatility in certain stocks. Some people would say it's technical. We're also seeing it in certain currency pairs. And there's been a lot of speculation about what kind of technical backdrop there is for this. Do you think that is cause to really build on your worry about a financial system that's stretched, that's seeing sort of outsized moves in response to not that significant catalyst, simply because there aren't sort of the buffers there have been in the past?
Yeah, it's a good point. I mean, my focus is more on the bond market, and you can kind of feel it there. The liquidity in the market just doesn't feel good. I mean, I've been watching the bond market for decades. You go back not too long ago, if you saw the 10-year Treasury yield move a couple, 3 basis points, you go, that's a big move. Now it's moving 10, 20 basis points in a day, in an hour. So I do think liquidity is an issue, and there's some structural problems there, right? I mean, the big broker dealers that make those markets haven't been able to or willing to expand their balance sheets to remain consistent with the growth in the amount of debt outstanding. We've got all this treasury debt coming into the market because of the large budget deficits, but because of capital rules and liquidity rules, banks have not expanded those balance sheets, and therefore the market just feels really fragile to me in terms of liquidity. And yeah, we could get a liquidity event, and it's happened in the past, and certainly is a risk going forward.
Mark, just before you go, I've seen a lot of growth scares in financial markets over the years. I'm sure you have too. I can't think of a time when I've heard so much about the SARM rule as I have this time around. It's like everyone's talking about it in financial markets. Now, I know in your world, in the world of economics, we've been talking about this for a while, but financial market participant, investor after investor, all talking about the same thing. Mark, if we trigger that next Friday, do you think market participants, based on conversations you've been having, will begin to behave like it's here, the recession's arrived?
No, I don't think investors are slave to any one indicator, and every indicator's got its issues. I mean, the SARM's rules, it's something certainly to watch, but, obviously unemployment is ticking higher because of labor supply, right? We've got a lot of foreign immigrants coming into the country, starting to work, and that's causing the unemployment to rise. So it depends why the unemployment rate is rising. Is it labor supply, as it is today, or is it labor demand? And I think it's more supply than demand. So you have to take all these things into consideration. And I think investors are pretty smart. They do that as well. But, it's just one other indicator, along with all the other indicators I just articulated, to suggest, look, the labor market's feeling a little squishy here. And again, why take a chance? Mission accomplished. You've achieved your goals. Let's get going.
Mark Zandi. Mark, appreciate it. Let's catch up soon. Mark Zandi there of Moody's Analytics on the Federal Reserve. Next week's an interesting one. We often sit here and we say it's the most important jobs report since the last one until the next one. I do think this jobs report next Friday takes on some additional importance, don't you?
It is definitely the most important report since the last one until the next one, 100%. And I will tell you it does, because we don't have a clear sense of exactly where we are on the trajectory.
It's not like that July 4th payrolls report when everyone went to the beach and Mike McKee was stuck here breaking it down. This one feels more important.
We had fun
Mike.
without you.
I'm sure you did. How important do you think this is next Friday?
I think Lisa summed it up well. Most important since the last one, because we're going to have another one before the September meeting.
True.
So it will continue to, although because we're so close to the Somme rule, as you pointed out,
yeah,
it will garner interest. Unemployment has to be the first number I mention on a week from today.
I agree. I think for a lot of people, that's like the indicator next Friday. Mike, appreciate it. Thanks for today. And this week, appreciate it. Thank you. Let's get you up to speed on some stories elsewhere with your Bloomberg Brief. Let's get over to Danny Berger. Hey, Danny.
Hey, John. The SEC is suing short seller Andrew Left and his Citron Capital, accusing him of committing fraud through stock trades, social media posts, and research reports. The SEC is alleging that Left and Citron generated about $20 million in illegal profits. The regulator claims that Left would make a recommendation alongside a price target and then capitalize on the resulting movements, but on prices far different than what he recommended. Left had no immediate comment. Canada has beaten New Zealand 2-1 in the Olympics women's soccer tournament, moving a step closer to a second straight gold medal. But the match has been overshadowed by an ongoing spying scandal. The Canadian Olympic Committee announced it sent the coach home after the team used drones to make unauthorized recordings of New Zealand's practices in the lead up to the match. The Canadian staff member flying the drone was arrested and given an 8-month suspended prison sentence by French authorities. And Vice President Kamala Harris is picking up another key Democratic endorsement, Barack and Michelle Obama.
Kamala.
Hello. Hi.
Hey there.
Oh, hi, you're both together. Oh, it's good to hear you both.
I can't have this phone call without saying to my girl Kamala, I am proud of you. This is going to be historic.
We called to say Michelle and I couldn't be prouder to endorse you and to do everything we can to get you through this election and into the Oval Office.
Oh, my goodness. Michelle, Barack, this means so much to me. I am looking forward to doing this with the two of you, Doug and I both, and getting out there, being on the road. But most of all, I just want to tell you the words you have spoken and the friendship that you have given over all these years mean more than I can express. So thank you both. It means so much. And we're going to have some fun with this, too, aren't we?
Harris earlier this week secured enough pledged delegates to clinch the nomination. It caps a whirlwind week that saw Democrats coalesce around her as President Biden decided to end his candidacy. Biden quickly endorsed Harris, but Barack Obama had been holding back. A person familiar with his thinking telling Bloomberg he first wanted to give the party time to unite behind a candidate. And that's your brief, John.
Danny, thank you. Thanks for today, and have a good weekend. If it was me, and obviously I'm not the vice president, but if the president called the former president, I'm sort of pausing and stopping. I'll sort of keep walking, you know, sort of super chill.
Well, it was fantastic B-roll.
Perfectly staged.
Yeah, it was good. It was good. It worked.
Perfectly staged. Let's put it that way. Up next on the program, setting you up for a big week ahead with a lot of tech earnings on deck, a Federal Reserve decision, and a payrolls report a week away. From New York, you're watching Bloomberg Surveillance.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, The China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Go on.
No, I'm good.
All right.
We're done.
Okay, we're done. 40 minutes away from the opening bell. Equities right now firmer by 0.7% on the S&P. Yields are lower by 2 basis points, 422.31. It's like collectively, take a deep breath. What a week, honestly, in this equity market.
I mean, to me, the weird part about this is we were talking growth scare 2 days ago. Definitely growth scare. I mean, that was basically entirely everything, and you just are seeing the confirmation everywhere. And then it was, this is a fantastic rotation. Check out those small caps. Check out high yield spreads. I mean, pick your narrative. It's like changing every day.
I think you had 4 different market regimes in the last 60 minutes of trading in yesterday's session. As we count you down to the opening bell, here's the trading diary for the week ahead. Let's get to it. Tuesday, jolts and consumer confidence data. Wednesday, we get the ADP report and a BOJ rate decision, together with a Federal Reserve decision as well, followed by a Chairman Powell news conference at 2:30 Eastern Time. On Thursday, another round of jobless claims, and on Friday, the July payrolls report. And if you look at that calendar, just for the week ahead, for the data and the central bank decisions, given what we know now, if I could have the outcome to any of that, I'd take the payrolls report over the Fed. Given that it doesn't sound like the Fed's going to do anything on Wednesday, based on their communication, maybe they throw in a surprise, I don't know, but based on what we know now, I'd take Friday payrolls.
I think a lot of people would agree with you. It was interesting that Victoria Fernandez of Crossmark came on here and said, actually, she has a good sense of all of it. She wants to see the Treasury refunding announcement to see exactly what maturities of Treasuries the U.S. government's going to sell. So a lot going on.
A lot of people in Camp Bramo, aren't they? Treasury refunding next week.
Do you know how many people have messaged me to be like, stay on the auctions? The auctions are important. Don't let John bully you about auctions.
John Bully, let me tell you how commercial breaks go. But not that way around. Not that way around.
Big bully.
AMH and Bramo teaming up.
Oh, yeah.
Giving me grief.
So terrible.
Let's get to the week ahead. It looks like this. The Mag 7 results coming in thick and fast. We hear from the likes of Microsoft, Meta, Apple, and Amazon. You've got to wait until the end of August for NVIDIA, and we've said it already this week that they need to change that. Mandeep Singh of Bloomberg Intelligence. Mandeep, do you agree? We need to bring that in. Why do we need to wait until the end of August for NVIDIA?
Save the best for the last. So, that's been the theme for the last few quarters. But clearly, I think Microsoft is very important in terms of keeping this AI trade going, because everyone realizes Microsoft is at the forefront of both ramping up the CapEx side as well as the cloud deployment. I mean, look, this is a company that has actually got a live product, Copilot, that is generating revenue. And look, you want to see that AI lift in the numbers when they report next week. So I think that's the one to watch.
You framed it perfectly earlier this week, and we extended that conversation through this morning with a couple of guests as well. If you look at the reaction to earnings so far, you can start to gauge what investors are rewarding companies for and what they're punishing companies for. And the example you used was Alphabet. Can we start there? What did investors punish Alphabet for? And how do you see that setting us up for next week when we hear from the likes of Meta and the other big players?
Yeah, I mean, in the case of Alphabet, they didn't have a timeline for when these CapEx increases would go away. I mean, they are clearly spending 60 to 70% above their historical CapEx, and typically this reverts to the mean. They're not saying that because they think it's a long runway. I think Meta is going to do the same. And look, as an investor, you don't mind, companies spending, especially the companies that generate $100 billion in free cash flow like Alphabet does. So it's a good way to spend on new technology, but you do want to see the monetization. And in the case of Alphabet, the search revenue did accelerate sequentially, but it was 1 percentage point of acceleration. So clearly they're not losing any share. They have kind of reclaimed their mojo in terms of, being ahead on the search side. but you do want to see a more meaningful lift, which is what everyone is hoping Microsoft can show in the results.
So we get Microsoft, we get Meta, we get Apple, we get Amazon all next week. Of those, which do you think is going to be potentially either the biggest surprise or that you are most curious about?
I mean, Amazon, look, in the case of Amazon, especially the AWS side, everyone thinks they are behind the curve when it comes to generative AI, because remember, Amazon is the largest cloud player. AWS generates $100 billion in revenue run rate. Azure is 76, and Google Cloud is 40 billion. But their growth rate seems to be decelerating. So this quarter, it's high teens. Everyone else is growing around 30%, Azure, Google Cloud. So you want to see them actually surprise to the upside, just to assure.
A guide again to suggest that the iPhone's struggling a little bit in the mainland, and then Apple came out last time around and said nothing to see here. There isn't a big problem. I just wonder if we hear the same commentary next week.
Yeah, and whether they talk about production and how much they're diversifying that, and whether they talk about the Treasury refunding announcement.
Of course they will. Yeah, that will come up too. Luca Maestri, by the way, is an amazing timer of the bond market, isn't he?
By the way, I just want to point out something. All of these big tech companies have benefited so much from rates where they are because they've got so much cash. They're keeping them in T-bills.
I've seen.
And they've been absolutely cashing in. So it raises this question of what is interest rate sensitivity for some of these
How did we get back to the deficit, Treasury issuance and that with tech firms?
You're
But we
welcome.
did. Okay, anytime. Mandeep, thank you. Appreciate it. Mandeep Singh there of Bloomberg Intelligence. Lisa, thank you. Appreciate it.
For what?
Anne-Marie, thank you. It's off next week, by the way. Anytime. Anytime. We'll see you next week on Monday. Terry Haynes of Pangea Policy, Lindsay Piexer of Stifel, Amanda Lynham of BlackRock, Kevin Gordon of Charles Schwab. From the team here at Bloomberg Surveillance, thank you very much for choosing Bloomberg TV. And if you can, please have a wonderful weekend. This was Bloomberg Surveillance.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
You look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, into dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
Futures are higher after a brutal week of trading. 30 minutes until the start of the cash trade. I'm Matt Miller.
I'm Sonali Bassick. And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, mild PCE data. The latest inflation reading did little to alter bets that the Fed will be able to cut rates in September.
And that eco data caps a turbulent week for markets full of underwhelming earnings. Apple gets set to headline another crucial week ahead for big tech.
And the SEC targets Andrew Left, U.S. authorities accusing the short seller of committing fraud through stock trades, social media posts, and research reports. We're going to get to all of that and more, but let's take a look at where markets are trading. Because we're higher after that PCE report, you can see the S&P 500, at least in futures, up 0.7%. You also have big tech rebounding right now. The NASDAQ 100 up by about 1%, actually. The bond market pretty quiet in the wake of that economic data. You can see 10-year yields currently lower by 2 to 3 basis points, Matt.
All right, two companies out with results this morning. 3M rising after raising its full-year profit forecast, and Bristol Myers also getting a boost after increased demand for its new medicines. I have the rotation chart here, though.
Take a look at it.
Is that something that you were going to say?
Yeah, you stole my thunder. We'll take a look at those stocks as well. But this is exactly what they're doing pre-market. Both rising about 6%, Matt. And of course, yes, giving fuel to that rotation. These indeed are not technology companies. But to end this week, a brutal week with brutal earnings. Certainly some green on the screen is welcome, Matt.
All right, I was going to say that
Ron Burgundy.
If you put it in the prompter, I will read it. I was going to say that the last 3 weeks, we've seen the biggest outperformance for the Russell 2000 over the S&P in history. So that rotation that you've been on about since the beginning of this show is actually happening.
Yeah, 2.5 weeks I've been right here. And it's interesting because it feels like we have the economic data to back it up in terms of the environment. But when it comes to the earnings piece, Sonali, remains to be seen. Of course, we're hearing from big tech now, and then we're going to get into some of those smaller companies.
You know, it's interesting. Since the start of the month, it's been a tough tape for the S&P 500 even. But if you think about it, the last 2 weeks have been pretty brutal. Even with the gain you're seeing today, it doesn't recover us from what this week felt like.
All right, let's talk about the economic data. PCE data coming out. Inflation actually a little bit hotter than the market was expecting. Let's get over to Michael McKee, Bloomberg's chief economics and policy correspondent, for the details. Mike?
But overall, the news is pretty good, and it should keep markets on path to a September rate cut by the Fed. Probably not next week, but personal income rises 0.2. That's less than anticipated, but it's good news overall, and I will explain why in just a second. Personal spending comes in 0.3. The May number revised up to 0.4, and what happened was that May and April were revised higher, so the June figure comes in a little stronger. We saw strength in consumer spending, and it was mostly in those 2 months. Now, as Matt said, the PCE headline number comes in as expected, up just 0.1. It's the core that came up a little bit higher, but it is not really an issue because at 2.6%, that's the same as last month, and it's telling us that we are seeing inflation continue to slow. Now, the important thing about the wage...
You said the same as last month and continue to slow. It sounds like stagnation to me, right?
It sounds like stagnation, but within the numbers, things are turning out a little bit better. And you look at the personal income numbers, and what we saw there is the wage and salary component halved to 0.3 from 0.6. So at this point, wages are still, though, running ahead of inflation. And that's good news for workers and good news for some people campaigning for president, I guess. The other good news within this number is housing is finally doing what the Fed wanted it to do. 0.3 gain rounded up for the housing component of this, which reflects much the same as the CPI. Housing is finally going down, not going down in price, but inflation getting to a reasonable number. Where does it leave us with the Fed? Basically where we were. A little bit stronger in terms of the pricing for 3 rate cuts this year, but we're still looking at a September start, and then we go from there.
Well, today is a momentous day. Just quickly here, Mike, it's the 1-year anniversary of the Fed reaching their terminal rate in their hiking cycle. And like you said, I mean, this seems like another see you in September sort of print.
It is, but but last September we weren't talking about cutting rates. We were talking about higher for longer. So it's taken a year. The Fed has left rates higher for longer, but we're finally getting to the point now where the economy has slowed enough and inflation has slowed enough that they feel they can normalize. And that's the important thing. We're not cutting because we think the economy is going into recession. The Fed wants to normalize rates, get rates to where they should be. And thank you for inviting me to the Fed anniversary party this afternoon.
Absolutely. Mike McKee, great to see you. Have a great weekend. That, of course, is Mike McKee. And let's keep this conversation going now with Caterina Simonetti. She is Senior VP and Portfolio Manager at Morgan Stanley Private Wealth Management. So there's a few different cross currents this week. Of course, if you take a look at the stock indexes, it's been super volatile. We have underwhelming earnings, like Matt said, but on the economic side, we've gotten pretty good data that, like Mike McKee was just saying, sort of gives the Fed the luxury of normalizing here. There's not the urgency to cut rates. What's the more important factor for you at this moment? Is it earnings or is it the economics?
Well, thank you for having me on the show. And it's definitely both. You know, as we look at the CPI data coming in somewhat lower than expected, you know, in just general, you know, direction of the economy, it seems more and more likely that Fed is going to start the rate cuts in September, you know, as expected. You know, the other part of it is, of course, the economy and the fact that the earnings have been mixed and below the expected rates in the areas outside of Max 7. And we see the pickup there, which is something that is really important for the overall growth and expansion of the economy. But the factor that weighs on the market more than anything is us going into the election season, and the presidential elections, as we know, historically come with a lot of uncertainty and a lot of volatility. So we are optimistic about the fact that we are going to see the rate cuts and that the economy is starting to recover in the areas, you know, outside of Max 7 where we have not seen returns at very high levels, the sectors like healthcare, industrials, materials, financials, but we tell investors to brace themselves for higher volatility.
You know, it's interesting, Caterina, if you look month to date, you have the Russell 2000 up more than 8%, while you're seeing declines finally hit the S&P 500 and even more so on that NASDAQ 100, as you've been talking about. And the sectors that have been winning this month are very, very interest rate sensitive: real estate, financials. How much more room do those sectors in particular have to run? And when people think about this rotation, should they be thinking about it by sector or by size of firm? You know, there's a lot of divergence here on whether those small and mid caps could be safe if we saw more economic softening.
Well, absolutely, and we have to look at it from, you know, two different angles. One is the valuations in small caps definitely seem attractive, but the question is, what is actually going to make these companies successful and profitable going forward? And this will be the cheap capital and access to labor that, you know, these companies will be able to afford. And we're not quite there yet. So when we talk about positioning of small caps and mid caps within investment portfolios, investors have to be ready to expand the time frame for them to achieve, you know, the desired rate of return. At the same time, as we look at the sectors that really have not performed at the same levels as, you know, some of the large tech names, the healthcare, financials, defense, industrials, materials, you know, this is the areas where the active stock picking makes more sense than ever. And we can identify and choose companies that have pricing power, competitive advantage, that have not performed quite as well, but are positioned for growth and are positioned defensively to perform better than, you know, some of the names that were in the leadership. But the question is, are they going to be able to sustain the level of earnings and the level of growth that we have been seeing over the last couple of years?
Right, and if we're not, that's why you want to be positioned defensively, Caterina. I look at your notes and my eyes are immediately drawn to the fact that you prefer consumer staples over discretionary. Is that a worry about the U.S. consumer? Is that a worry about the U.S. economy?
Absolutely, Matt. The U.S. consumer has been hit, you know, with high inflation, high interest rate, market uncertainty, they're sitting on the sidelines and not sure, exactly what to do. And what we tell our clients is that, defensive positioning, diversified portfolio, actually taking a close look at the asset allocation, because a lot of people are over concentrated in specific names and specific sectors without even realizing this, which subjects them to higher level of risk. And there's always, investment grade corporate bonds as safe haven. So there are places where portfolios can be positioned, in light of the higher volatility, in light of the potential market, fluctuations that are wider than normal is something that we're expecting going into the election season.
And Katerina, I want to talk about defensiveness in the context of an overall portfolio, because I'm taking a look at the correlation between SPY and the ag, and it's actually been positively correlated since about 2023 or so. So looking at that chart, it seems to suggest that bonds aren't providing that portfolio buffer, that they're not acting as a haven asset. And with that in mind, that bonds aren't necessarily fulfilling that duty, what is the haven in a portfolio right now?
It's an absolutely fair statement, especially considering that historically, if we look at last couple of years, we came out of the environment where interest rates were going up and bonds on the portfolio level significantly underperformed. But going forward, it's going to be a very different scenario. Investors now have an opportunity to lock in the rates, lock in the quality for the first time in many years. And going forward, as the rates on the bond side of the portfolio will remain at the high levels, we have to be conscious of the fact that money markets are the rates that are variable are going to start declining the moment Fed is going to start cutting rates. So really the defensive nature of the portfolio combines the yield and the income aspect. When we look at the yield from dividend-paying stocks, from defensive areas like REITs, and also of course, the bond side of the portfolio, focus should be on quality, diversification, and locking in the higher yields for longer timeframes. So the bonds can have that defensive play in the portfolios.
Katerina Simonetti of Morgan Stanley Private Wealth Management, we thank you very much for joining us. And of course, happy Friday, happy weekend to you. Another piece of M&A news to round out the week. Of course, it's been a strong week for deal-making. Apollo buying IGT's gaming business and Every Holdings in an all-cash transaction. And those stocks are just soaring pre-market ahead of that news. You have International Game Technologies up more than 15%. Every Holdings up almost 42%. Apollo up almost 7%. This is not their first deal this week. Private equity back in action. Let's get a look at some of the other stocks moving ahead of the opening bell. Here's Abigail Doolittle. Abby.
In particular, Shonali, we have lots of earnings movers to take a look at. Let's start out with the shares of 3M, the multinational conglomerate, absolutely soaring, up about 7%. They put up a big beat and boost. They beat the top line estimate by 7%, bottom line by 5%. The new CEO, Bill Brown, really doing a good job with the takeover and focusing on growth going forward. Let's take a look at the shares of Bristol Myers Squibb, because they are also higher. Another big beat and boost. This stock also up about 7%. Their outlook was taken up for the adjusted profit view for the year to 90 cents from 60 cents. That's really a pretty big guide to the upside for a drug maker, and it has to do with some of the company's newer drugs. And then finally, rounding it out, Deckers. Well, these shares are up more than 13%. I was expecting there to be a big short interest here for a squeeze, but that's not the case. Investors liking the massive beat, the big outlook raise. Some analysts saying that the 10% growth that the company is modeling for in the top line, that may actually prove to be conservative, Matt, because of the strength of both Hoka and Uggs.
All right, interesting stuff. And on the sneakers front as well, Abigail Doolittle, thanks very much for that. Coming up, Ford trying to recover after its worst day in over 15 years. The stock had its worst performance since the great financial crisis. We'll discuss the problems ahead for the automaker next. This is Bloomberg.
The names that move markets are on Bloomberg.
You know, with all due respect and thoughts and empathy and sympathy for the people who are suffering at the moment, and there are plenty. It's not just Ukraine and Gaza, it's in many other corners of the world as well. But I'm constantly surprised by the level of resilience and the capacity to actually bounce back from those traumas. So I have faith in the human beings and their capacity to respond to adversity. We've seen it. You know, look, earlier in the pandemics, we thought that the world was coming to an end, right? It hasn't. Nobody thought that vaccines would come up in such a short period of time. And every time we have to constantly resurrect this spirit of resilience.
But are you hopeful that...
I'm always hopeful. Oh, come on, we have to be. We have to be.
Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Let's get now to high interest, a look at what's making headlines around the world. The Obamas have finally officially endorsed Kamala Harris for president. The video that you see here was posted by Harris on social media. In this video, you can hear Barack and Michelle Obama express their pride and pledge willingness to help the presumptive Democratic candidate to win the presidency. Investors have fallen all over each other in recent weeks to buy the yen, but that could change next week. The bet is that interest rates are finally about to tip in Japan's favor. The market faces, though, a moment of truth as soon as Wednesday when the Bank of Japan makes a decision on its key rate. And trains to and from Paris were hit by what authorities call a massive attack aimed at paralyzing the network of France's super-fast trains. The physical attacks, including fires set at 3 critical rail line nodes, came just hours ahead of the opening ceremony of the Paris 2024 Olympic Games. About 800,000 passengers will be affected. Shares of Ford are rebounding slightly this morning after suffering their biggest drop since 2008. Investors were caught off guard by an $800 million spike in second quarter warranty costs. Joining us now is James Piccirillo, senior auto analyst at BNP Paribas Exane. James has a neutral rating on Ford with a price target of $12, and you can see they trade still for $11.23. But James, I guess the earnings and especially the warranty costs don't really give you a lot of confidence in Ford's ability to execute.
No, not at all. You know, the expectation heading into that second quarter print was for Ford to follow GM's suit, which is beat and raise numbers on the back of strong pricing, strong mix. And Ford, the problem there, this year has a substantial amount of launches, model refresh launches, and that's something that Ford has struggled with over the last 5+ years. And we saw that yet again this quarter with that $800 million in warranty costs, which tied to model year 16 and model year 21 vehicles. So their problems of the past continue to pop up and disappoint, clearly disappoint.
How do they move on from that? You saw management really trying to guide into the future and get investors to look past the quarter, but to the point that you're making here, it's a history here of execution. So what do they have to show to prove that they could turn things around?
Yeah, you know, they have a substantial amount of launches, as I mentioned. Cleanly executing on those launches this year for the second half certainly will help move the tide for them, right? They are, you know, they're a true show me story right now after a second quarter disappointment, and it comes down to these clean launches. Now the problem there for these guys is clean launches thus far have also led to lower volumes, and so you can see volume downside to improve the quality of the launches, and that's also a pillar to our cautiousness on the stock from here. But there is an avenue, and it comes down to execution, and showing the commercial-facing business, the Ford Pro business, which this year is going to drive $9.5 billion out of the $11 billion of adjusted EBIT Ford is going to report. That's the business that needs to really be the focus.
Let's talk about how long that might take, because we heard from CEO Jim Farley saying that Ford's now testing vehicles to failure. They're running them at extremely high mileage to find those quality problems. He said, though, it will take as long as 18 months to see the benefit of that. 18 months, does that sound like a realistic timeline to you?
Yeah, it does. That seems like a fair timeline, for sure.
Ford Pro, I noticed that the margins were down slightly, but it's the unit, as you say, that everybody's put so much hope in and Jim Farley has focused on so much. What do they need to do, and why is that business more important than, say, Blue, which sells the consumer-facing F-150?
Yeah, that's exactly right. You've got the Ford Blue segment, the Model E segment, and then Ford Pro. Ford Pro is the crown jewel for Ford. And just in the next 2 years, you're going to see software and services account for 20% of Ford Pro's EBIT. Software and services, that reduces cyclicality, should further improve the margins for that segment. And so there is a lot of positive momentum for Ford Pro. For the other two segments, we covered Ford Blue and the retail, the warranty issues. That business is a show-me story for the second half. And then we can't forget about Model E. This is the EV business. It's going to lose $5 to $5.5 billion in earnings this year. Major struggles. And the question then becomes, we have emissions compliance that needs to be hit by each automaker. And Model E is the force for Ford to be compliant. Otherwise, they have to tap into emissions credits.
Yeah, but very expensive, right? I mean, they're going to lose $5.5 billion on their electric vehicle unit this year. Bloomberg Intelligence put out a figure: 25% of auto loans are underwater. And I imagine that's almost all due to EV sales, right? There's a guy on Adam Carolla's podcast, Matt the Moderator, who bought a Ford Lightning for like $100 grand, and he can resell it now for like 60. That's the story across EVs. When is that going to turn around?
Yeah, I would like to say, when we think about the health of the auto industry from the lens of the industry's total auto loan, been lower, meaning the credit quality of auto loans is still very high. The clickbait articles out there would say, will sometimes say default rates within subprime are at all-time highs and have reached peaks that are north of the global financial crisis, which is true, but subprime as a percentage of the total auto loan book has never been lower. And so I'm not, that's not a caution of mine. If we look at 90 days delinquency, that's also at a very normalized level. It's certainly off the very favorable lows that we saw just 2 years ago when we had auto loan grace periods from the industry during the COVID period, but we're still at a very normal rate on delinquencies.
James, we thank you so much for joining us today. Of course, that was a big story with Ford dropping as much as it did. That is James Piccirillo of BNP Paribas Exane. Now, coming up, we're going to take a look at the companies making the most buzz on social media today. That is Social Climbers up next. This is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
All right, time now for Social Climbers. The company's making waves this morning. And first up, Dexcom shares plunging after the medical device manufacturer cut its full-year revenue guidance. The stock downgraded to neutral at JP Morgan, with the analysts citing severe and sudden near-term challenges. Now, next up, as we go swiftly along, Coursera shares soaring on a sales beat. The online educational company also surpassed more than 2 million enrollments in its generative AI catalog of courses. Of course, you can follow all the latest company buzz on TREN Go on your Bloomberg terminal. Now, coming up, we'll be speaking to Larry Adam. He is Chief Investment Officer over at Raymond James. Why he sees any pullback as a buying opportunity. That's next. This is Bloomberg.
The linear business is not going anywhere. The sports business is moving and is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be. Every single one of the players want to be in it because of the audience. We have two assets in the sports business that are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
Moments away from the start of trading after a brutal week for stocks. So much volatility, but at least right now we have a little bit of green on the screen. This is Bloomberg Open Interest. I am Matt Miller. You can see S&P futures up about 0.7%. NASDAQ futures up almost 1%. There's the opening bell. On the New York Stock Exchange, you have members of the executive group of Betway, which is now, I guess, leading betting for Manchester City and other soccer games. On the NASDAQ Stock Exchange, you have NIP Group there ringing the bell. Let's get over to Katie Greifeld right now to see what's going on with the indexes just a few seconds into live cash trading. Katie?
Just a few seconds in, and it's an interesting picture. You can see green on this screen behind me. It feels like a little bit since we've seen that. The S&P 500 currently up about 0.6%. Big tech back in charge, at least for the moment, up about 0.7%. But it's the small caps, once again, 1.5% higher on the Russell 2000. This would be a third straight week of gains for this index, which is almost exactly the amount of time we've been doing this show. So there you have it. But let's take a look at one specific stock, and that is Bristol-Myers Squibb, raising its 2024 profit forecast, increased demand for its new medicines, really giving investors hope that the company has gotten past a dip in performance. You can see that in the shares right now, currently higher by about 6%, Shonali.
Also higher, 3M. You're looking at about a 10-11% rise in the stock as the market opens. 3M raising its full-year profit forecast. It's a sign of progress that the company's new CEO can reinvigorate the manufacturer after a lengthy period of turmoil, Matt.
And NVIDIA back up this morning after the Mag 7 having been lagging the last couple of days. It's been, as I said, a brutal week for stocks. Anytime the Mag 7 are down or NVIDIA is down, that usually means that the indexes fall as well. But we've seen a little bit of a turnaround in terms of the breadth. Let's go over to Abigail Doolittle right now and get a check-in on what's going on. Abby?
I would tend to agree with you, Matt. It is all about NVIDIA this week. The Mag 7, but driven by NVIDIA, because surprisingly on the day when Tesla and Alphabet were down, it was NVIDIA that was the worst drag on the markets. And here you can see it. There was a 7% decline. Yesterday, massive volatility. When markets were at the lows, NVIDIA down about 7%. It then turned higher, ended up closing down about 1.7%. Right now, up about 3% on the day. So a little bit of a rebound today. Let's see if it holds. Lots for this stock and these investors to contend with, though, given the fact that at one point the stock up peak or trough to peak from the 2022 lows about 1,200%. Too far, too fast, especially as growth slows. Let's put this together with the chart, because this past year, the growth on the top line was 126%. The bottom line, 365%. This is expected to slow into the January year end dramatically to 127%. That might be one reason that we are looking at a bit of a breakdown that is somewhat obvious to anybody when you see it drawn with this trend line. The RSI, a momentum indicator, it is heading lower. So long as NVIDIA, Katie, stays below 118, it confirms a pattern that would fill a gap here. You have all these technical measures coming together, suggesting it's very, very likely that NVIDIA will fall sub 100. Stay tuned.
All right, Abigail Doolittle, we'll keep our eyes on those lines. Thank you for that. And let's put it all together with Larry Adam. He is Chief Investment Officer over at Raymond James. I'm going to go straight to this line in your note that we continue to look at these pullbacks as a buying opportunity. Amid all the volatility that we've seen over the past couple of weeks or so, what gives you the confidence that you're potentially buying the dip here and not just trying to catch the knife?
Well, I do think we've been looking for a pullback because of some seasonality patterns. There was some over-optimism really baked into investors' sentiment. But I do think when you look longer term, I think earnings are going to be fine. I think we're going to see a broadening of participation, which means that we still like tech, but I do think that earnings are going to start to at least start to match tech towards the end of this year. So that'll help drive the broader market higher. And then don't forget, we have a Fed that's going to start an easing cycle, and that'll hopefully avert a recession here. And as long as there's no recession, I think earnings can continue to move higher and support this market.
Are you not worried about a recession? I noticed today it's a small thing in the numbers, and it's only 1 month, but personal income was only half of what the street was expecting, and it was less than personal spending, which is a lot like, you know, my house, and I could face a recession soon.
Well, to your point, then you also saw the savings rate, right? The savings rate was the lowest that it's been since 2022. So clearly the consumer is starting to get crimped. We think that that's why the Fed has to go. They probably should go next week, but they don't like to surprise the market, so they'll probably wait till September. There is a risk associated with that. But I do think one of the offsets is the fact that you are still seeing pretty strong corporate spending, particularly when it comes to AI. And then government spending remains pretty healthy with all of the stimulus that's been put out there. So I think those two indicators, when you look at the numbers, are going to continue to offset any softness that we do see coming from the consumer.
You know, it's interesting. You think back to the Bill Dudley commentary a little earlier in the week saying that the Fed should cut next week because of worries about a recession. And you also are saying that perhaps they can cut next week, but we'll wait. What happens between now and September? As rates stay higher, if they stay higher, then how much more does the consumer get crimped? What are those ripple effects?
Yeah, well, clearly, as I mentioned, the consumer is starting to get crimped. You're starting to see delinquencies moving higher. But I think behind the scenes, you're seeing longer-term interest rates, which have a bigger impact on the economy, are actually starting to move lower, right? The 10-year Treasury yields approaching 4.2%. Hopefully, that'll start to stimulate a little bit more of the housing market. You know, auto sales have been struggling here of late. Maybe that'll start to help those as well. So behind the scenes, we're hoping that you start to see the consumer at least being able to borrow so that they can continue to spend, so that the Fed has time then to eventually cut rates.
And let's fold this all into the rotation trade that we've been seeing in the markets. The Russell 2000, your small caps, have been the leader here, actually on track for a third straight week of gains, which is pretty amazing to think about. You think about what's going on in the economy right now. You think about what's going on with earnings. And I've heard a lot of people pin their hopes on this rotation trade to the idea that we're going to see that broadening out in earnings as well. Is that your base case? How are you feeling about it?
That is our base case. In fact, we think that by the end of this year, by the fourth quarter of this year, small cap earnings will be matching what you're seeing from the Mag 7 or the Mag 6 is what we call it, right? I think that that's important. Historically, once the Fed starts to cut interest rates, that's when you see small caps start to outperform. And when I look at valuations are pretty attractive in the small cap space. So from that vantage point, I think that's why you're going to see some of the broadening. And then when you look at the sectors that we continue to think will benefit, meaning healthcare, industrials, technology, you get a little bit of exposure there in those small caps, which should help drive that index as well.
What do you think about energy and real estate, Larry? I mean, if we're all going to be taking part in this AI revolution, they're going to need to have data centers, which take up a lot of space and need a lot of power.
Well, when it comes to energy is another one of our areas that we do like. That's based on the fact that we think energy prices, if you look per barrel, we think it'll go up to about $85 per barrel, which will help that sector. If you look at the corporations in the energy space, what are they doing? They're doing a lot of shareholder-friendly activities. They have buybacks. They're increasing their dividends. So that's one area that I think is still pretty attractive. You mentioned data centers. That's an area that we think will continue to do well. But again, when it comes to real estate, you got to be really selective, right? You know, broadly speaking, if the economy is slowing, real estate will struggle overall. But I do think specific areas like data centers will continue to do well.
Larry, what else do you avoid in this market? I can appreciate buying into pullbacks, but beyond real estate, where else do you stay away?
So we continue to favor the spending by corporations over the consumer, right? As we've been talking about, the consumer is struggling, whether it's because of delinquencies, whether it's the fact that they're probably not going to be able to spend as freely. They're starting to balk at price increases. So that's probably going to crimp the margins of the more consumer-related sectors, both staples and consumer discretionary. So those are the areas that I would probably avoid. Again, I want to be in the areas where businesses are spending. So that's why I still like tech. We like industrials. We do like healthcare. Those are the areas I prefer.
Larry, we thank you so much for joining us. Happy Friday to you. That is Larry Adams of Raymond James. Now coming up, a closer look at the lawsuit the SEC filed against Andrew Left at Citron Capital. That's up next. This is Bloomberg.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what's going on in stocks. We're seeing a gain on the S&P 500 just about 12 minutes into the trade of 0.7%. NASDAQ rising about 0.6%. So not the big pop on NASDAQ that you would have expected from the big jump in futures earlier this morning. Nonetheless, a little bit of a reprieve from the losses we've seen this week. So far this week, the S&P 500 is down more than 1%, and that would be the second more than 1% weekly drop in a row. Katie?
Third week of gains for the Russell 2000, though, so something to keep an eye on there. But let's get to our top calls. Some of the analyst action in focus this morning. And first up, Phillips Securities cutting Tesla to sell. The broker notes that the automaker's near-term margins are expected to be pressured lower by volume, pricing, and EU tariffs. Next up, we have Morgan Stanley downgrading Weight Watchers to equal weight. The analyst cites lackluster trends for its core behavioral dieting app business and its clinical segment. And finally, we have Deutsche Bank upgrading Lockheed Martin to a buy. The analyst says that the company's strong second quarter results point to an attractive beat/raise opportunity in the second half of 2024, Shonali.
And Katie, we're looking at another story here. The SEC announced that they are suing Andrew Left and Citron Capital. The regulator is alleging that Left and Citron committed fraud and made illegal profits to the tune of about $20 million. For more, we're going to check in with Bloomberg's Bailey Lipschultz and talk us through exactly here what the SEC is alleging that Andrew Left and Citron did.
So the SEC and the Justice Department also, they're both alleging that Andrew Left a number of things, but most notably, he came out with calls both to the long and short side, initiated price targets, and loaded up on positions before unveiling that research. The stock would move, and then he'd quickly close the positions to profit very rapidly. So he'd make bets not only on the underlying stock, but also use options, basically saying, at least when you look through the Justice Department press release, saying that he wanted to make fast, easy money using those mechanisms.
Yeah, it's pretty amazing. He sometimes suggested that stock prices would fall by 50% or more, but then actually closed his positions after share prices had only moved a couple of percents. That's according to the indictment. Tell us a little bit more about Andrew Left, though. I mean, what do we know about him and what's he known for?
He's known for being kind of bombastic. He did actually announced back in 2021, he was on the kind of receiving end of the wrath of the GameStop movement. So he said he was no longer going to make public short calls because he had built out such a vast following with the likes of betting against Valiant, among a broader range of investments that he kind of ended up being right on. But when you look at kind of what he's done and when he kind of started backpedaling 3 years ago, that also was when the SEC and Justice Department started investigating short sellers, some of their relationships to hedge funds. So he's been under the microscope from a regulatory standpoint for quite some time, along with a number of other players in the space.
But some of these allegations have to do with his longs as well, right? It's not all about him being a short seller. And when it comes down to it in the indictment, they're not suing him for shorting stocks. It's really about the way that he publicized his calls and then acted in his own trades.
Exactly. Reading from the SEC press release, they list an example that he said he would stay long a stock until the price hit $65, when in fact, according to the release, they immediately began selling the stock at $28. So coming out with these calls, loading up on positions, basically using his stature on social media, whether that's X or also going on TV and talking about positions, and then quickly profiting from them, according to some of the documents from the Justice Department and the SEC, he basically would put limit orders out. So he would close out those positions even if it kept going or kind of
in the parlance of our times, that would be called a pump and dump scheme.
Yes.
Well, even more than that, he was setting up apparently fake websites, wasn't he? To what extent did this go to? And is this a one-off? Yes, perhaps they found this because of that short selling investigation, but it doesn't seem like every short seller is out doing this.
No, well, there's a lot of skepticism around short sellers, and that's kind of to Matt's point. Is it misaligned kind of allegations where you come out with kind of this call that a company should drop 60% and you're going to hold on to that short bet? Or do you close out your position when it drops 10%? So when you look at some of the findings, again, the SEC document saying they found these alleged bait and switch tactics that Ned had left in his firm $20 million. So not only did he have those, according to the filings, those accounts to help promote some of his calls, there's also potentially taking backdoor payments from hedge funds that's being alleged in some of these lawsuits, that there was partnerships with something around balance sheet.
Is there anything that we can extrapolate out from what we're seeing in this very specific case, these allegations, to the broader short selling industry? Because you know pretty well that it seems like it's been a dying breed. We've seen less short sellers. A lot of them have gone underground. What's next?
No, I think that we're going to be closely watching to see if other prominent names that were part of these investigations are going to be facing similar lawsuits. Because as you mentioned, it has been a dying breed. You saw Jim Chanos pulling out from short selling and closing that fund. You've seen a number of short sellers who are pretty prominent, either making less calls or just kind of going after smaller companies, whether that's Chinese firms and tiny operating firms that operate offshore, as opposed to some of these bigger names when you're targeting the likes of an Adani Corp, which is what we saw with Nate Anderson and Hindenburg.
All right, Bailey, thanks so much for joining us. Great coverage on this story. We should remind our viewers that these are just allegations by the SEC. In this country, you're innocent until proven guilty. We have contacted Andrew Left, and he didn't have any immediate comment on this story, but if he does, when he does, we'll bring you his response. Coming up, Evercore's deals full fuel record revenue. We're going to take stock of boutique banks and how they're doing in our Wall Street beat. This is Bloomberg.
season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
DOJ or other authorities.
Could face bigger challenges next.
Fed was going to keep rate World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
This is Bloomberg Open Interest. Let's take a look at where markets are trading. And you can see green on the screen, a little bit of a bounce, a rebound here to end the week. The S&P 500 up by about 0.8%. Big tech is your relative underperformer today. The NASDAQ 100 up about 0.6%. Small caps once again leading the way here. The Russell 2000 up 1.7%. I'll say it again. This would be a third straight week of wins, Shanali.
And it's time now for the Wall Street Beat, because there is a class of banker on Wall Street that is certainly winning. We are looking today at the boutique banks, with Evercore posting record revenue this week as a deal-making rebound fueled a surge in advisory fees. Joining us now is Bloomberg editor Matt Monks. And if you think about it, after a slump that we've seen, Matt, in deals recently, the comeback that we've seen seeping through this year, the fact that Evercore stock is hitting a record, Lazard had its best day since Peter Orszag took over as CEO. Are deals really coming back at that speed?
Not yet. We're coming off a very low, right? But if you look at the read-through, is very positive for these three firms that reported this week, right? Advisory fees up, way up, in some instances, 50% for Evercore and Moelis. Lazard, not so great, right? Compensation ratio is holding steady, down a little bit. Their business model looks good, hiring talent. They're not going out too far afield from that. And then also the commentary that we heard from them, private equity, looking pretty good. Restructuring, coming back. Got some nice stuff in the equities pipeline. I think that things look optimistic, but you have to keep it in mind this is off a very low.
And I was reading in the Bloomberg Intelligence notes on Moelis, they say sizable additions of senior talent are coming at a cost. So even though there's this, I guess resurgence maybe is too strong of a word, but come back in terms of deals, they're having to pay for talent, and that's going to eat into profits.
So there are, what, a half dozen boutique investment banks, maybe 12, depending on how you look at it. Their business model is very simple. Hire the best people that you can get, go out and win the mandates. They don't have the diversified balance sheet to win that other kind of business. So it really is, it's a talent war, and you have to pay up to win it. They're on a very fine line, though, right? If that activity doesn't pick up to match the revenue that pay for these people, they're in a bad spot. But right now, things look pretty good as far as it goes.
You know, it's fascinating, too, to the point you're making here. You know, a banker at Goldman will say, for example, Evercore is outbidding everyone. That's but right. What is the payout to that? Evercore now is actually beating Bank of America, Katie, in terms of the deal volumes that you're seeing this year.
Yeah, absolutely. But to Matt's point, paying up to do that, we heard from Evercore's senior chairman, Roger Altman, really crediting that revenue game to the consistent expansion of senior managing directors. Have to imagine that's a pretty fine line to walk there. But let's look ahead to what's next, because we think about next week, we do have some interesting private equity results coming up.
So listen, when it comes to private equity, I'm looking at it from the private equity front, from the deal-making front, right? I mean, private equity deal-making is the engine of all Wall Street. When private equity shows up, you see deals show up, you see it spike, it reads through to activism, equity offerings, everything. So that's what I'm looking for, the commentary coming out of them. And these guys have had a hard time not only putting money to work, but finding exits. So let's see what the commentary is on that front.
Also, fun fact, guys, KKR was on their IPO this week of OneStream, as well as a debt underwriting. But, you know, beyond private equity, big deals, antitrust, how much worry is there still? Peter Orszag was kind of just shunning it off, but Lina Khan does not look like she's backing off.
It's a huge overhang, right? We don't know what's going to happen if a new Trump administration gets in there. And even if a Trump administration gets in there, it's not clear that the pendulum is going to swing that far in the other direction. J.D. Vance, not a big friend of Wall Street. doesn't love big tech, right? So there will be a little bit of pendulum swing, and no matter who wins, you will see an overturn at some people at the DOJ and the FTC, but it's a massive overhang. Like, look at what's going on with Kroger and Albertsons this week, right? It's held up by the FTC, it's held up by the states. It's not going away. That said, people are still striking big strategic deals, and the read-through there is if you are willing to fight, there's a good chance that you're going to get through.
That's right. And politicians don't always do what they say they're going to do if and when they actually get into office. Matt, thanks so much for joining us. Bloomberg's Matthew Monk's on our Wall Street beat. Coming up in the next hour, more on Wall Street with the former FDIC chair, Sheila Bair. Right now, I want to get to the trading diary, what you need to be watching next week. We get central bank earnings from the Federal Reserve, BOJ, and BOE. Sorry, earnings, did I say? Hearings is probably what I meant.
Meetings, whatever.
Earnings. We get big tech earnings, not hearings, for most of the top names from Apple and Amazon to Qualcomm. We get a slew of earnings really all week. We're deep in it in terms of earnings season. Type EA Go on your Bloomberg terminal. Monday morning, kick it off with McDonald's. You get JetBlue, KKRs we were talking about, as well as Apollo and Ares throughout the week. Coming up in the next hour, Ellen Hazen, Chief Market Strategist at FL Putnam, joins us. She says the rotation into small caps doesn't have any legs.
Those are fighting words, Ellen Hazen. I'm excited to get into that one.
This is Bloomberg.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors, including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Friday, everyone. We made it. This was quite a week where the consensus trades were shaken out, and now we're finishing up with that aftermath. We have a lot coming up for you in the next couple hours. We're going to break down all the market moves. Plus, take a look at that economic data. UMich final just dropping right now. We also had that PCE. Lauren Sadel-Baker is economist and senior consulting speaker at ITR Economics. She'll be joining us. Plus, it was a week for cars, and not a great week for cars. Steve Mann, Bloomberg Intelligence Global Autos and Industrials Analyst, will be joining us as well. And then the ever-amazing Steve Major, Global Head of Fixed Income Research at HSBC. He doesn't live here. He lives in Asia, but he'll be here in studio. This is going to be a very big deal. And Paul Sweeney is sunning himself on the Jersey Shore. So John Tucker is joining me for the next couple hours. Hi, John.
But I'm prepared for the shore. And you see that?
Oh, God, don't hurt yourself.
My flamingo socks.
He has flamingo socks on.
I will be on the beach later today.
I don't know what else to say about that. Like, that feels like a drop the mic moment. John Tucker is wearing flamingo socks, and they're so cute. Anyway, that's where we are on this Friday in the studio. Also, Lisa Mateo joins us for a business flash. Lisa.
Oh, I'm glad you didn't pull a hammy, Tucker. I was worried for a second.
I got to recuperate.
And Market Drivers brought to you by Interactive Brokers. Discover the future of trading with their next generation trading platform, IBKR Desktop. Download IBKR Desktop at ibkr.com/desktop. Well, stocks on the rise after the Fed's preferred inflation gauge rose at a mild pace in June. Consumer spending stayed firm. We have core PCE increased 0.2% from May, 2.6% from a year ago. Then inflation-adjusted consumer spending, that also rose 0.2%, while May's increase, that was revised higher. Now we go to sentiment, just coming in with that read from University of Michigan. The survey was for 66.5, came in at 66.4, which is also a tick higher than the prior report. All that said, we have the Dow up more than 1.5%, the S&P 500 up 1%, and the NASDAQ up nearly 1%. The two-year yield at 4.39%, down 4 basis points. The 10-year yield at 4.19%, and that's also down 4 basis points. To commodities, we have spot gold higher, $2,384 an ounce. We have Brent crude, $81 a barrel. WTI crude, $77 a barrel. And lastly, currencies, the dollar weaker, Japanese yen weaker, at 153.95 against a dollar. Euro, British pound stronger. Bitcoin up 4%, 67,922. That is your Bloomberg Business Flash. Over to you, Alex and John.
All right, thanks so much, Lisa Mateo. You know where you can't wear those flamingo socks?
Well, I was going to say pretty much anywhere.
Paris.
Why not?
Yeah, I mean, I kind of feel like if you were at the Olympics and you wore those socks, they might not let you in.
No, these would fit right in.
You think?
They're stylish.
Well, only if you wear them with like Birkenstocks. Also, maybe that's the way forward for Paris. But that was my not so clever shift to what's happening in Paris. So, okay, we get the opening ceremonies coming in a couple hours' time. If you can get there, considering the train sabotage that we saw. Jenny Che is Bloomberg Paris breaking news reporter, and she joins us now. This was a tremendous moment for Paris, and this is the way that it opens with sabotage, just hours before the kickoff.
Yes, authorities are calling this a massive coordinated attack. Fires were set off at several critical train nodes in the country, and these were targeted to have the maximum possible disruption on train lines. At the moment, we don't know yet who is behind these. Paris prosecutors are investigating, and they've indicated that there could be charges related to undermining the nation's interests.
It sounds, I'll put on my Inspector Clouseau hat, it sounds like these are local players, not some international player like Russian terrorists or anything like that, because it was so targeted and they seem to know what they were doing. So it leads me to my question, was there some sort of labor disagreement between the trade unions and the folks who run the trains?
So far, there are no big major strikes announced ahead of the Olympics. The ones that had been announced were canceled. But yes, the targeting does make it seem like these were people who knew the rail lines, and authorities have condemned the attacks, of course. And but the Interior Minister also did say that over the past few weeks, his services had foiled several attacks that were targeting the Paris Olympics.
Before I let you go, Jenny, any sign of when the trains might be up and running again now?
Traffic is starting to resume. The transport minister said that a third of the trains should be back this afternoon. And of course, this has been hard for people who are coming into Paris to see the opening ceremony from out of town. Obviously, with train delays and cancellations, the doors to the opening ceremony closed at 6, so that might get tricky.
All right, Jenny, thanks a lot. We really appreciate it. Jenny Che is a Bloomberg Paris breaking news reporter joining us there. All right, let's get back to the markets here because the NASDAQ is up 0.6%, S&P up 0.9%, but it feels like we're off the highs that we saw in the futures market. So definitely keeping an eye on that. Bailey Lipschultz is Bloomberg News senior equities reporter, and he joins us now. Bailey, what are you watching?
A lot going on as earnings season keeps churning. So I want to start with Dexcom. They are a diabetes management device maker, which
I think we had the CEO in here a little while ago, right?
This requires a memory, so I have no idea. Go ahead.
Yeah, no, it was. It's the thing that you put on your arm,
that round
and
thingy?
it gives you a readout on a watch or a device, like what your blood sugar level is at. And interestingly enough, it's just like he was saying that it's not just for people, diabetics, but if you're a healthy
Athletes,
person, athletes,
cool
want to
technology,
monitor that.
but not great results.
That's weird. What happened?
It's down 40%, which is pretty eye-popping because the company now is a $26 billion firm. This time yesterday was $43 billion. They cut expectations for the full year. The interesting thing is that they seem to be losing market share to Abbott, so a much larger player in the space. But the underlying uncertainty when I was talking to a couple of healthcare traders this morning is that this is before the GLP-1 craze could actually impact their business. So there's so much uncertainty. If people lose weight and don't have diabetes, then obviously you don't need a management system. This is before that kind of market potentially really takes off because there's so much excitement around what Novo and Lilly could bring to the table. So when they cut their sales forecast again, that's why you're seeing it down 40%. But even management saying that self-inflicted issues are hitting the company, which is not what investors want to hear ever.
You really want to spike your blood sugar levels? Eat oatmeal in the morning.
What?
Yeah, I
No.
was shocked.
Wait, sugary oatmeal, sure.
No, not even sugary. It's just sends
Do you like oatmeal?
Through the
Wait, really? Wait, how is that a thing? How do we know this?
I just know it because it happened to me, and I'm like, what the heck?
Do you know it like you know
Well,
your
no, I
flamingo
was
shot?
going for a blood test.
Ah, okay.
And I just had a little oatmeal because, and
But
they're
did you
like,
have the stuff with the sugar and the raisins?
No, it was
and
regular.
it was just regular, plain, boring
plain,
oatmeal.
Tasted like
Cardboard.
wallpaper paste.
Mhm.
So.
Interesting.
I don't like it. I'm a texture guy. I don't like oatmeal.
Yeah, no, I do. I love it.
Throw that out.
Anyway, okay, let's move on to a different one. Bristol Myers Squibb, that stock up almost 10%.
Almost 10%, best day right now on an intraday basis in almost a decade. They raised their profit forecast driven by some of their newer drugs, which was surprised at the upside for analysts. When you look at this company and when you look at kind of the broader biopharma space, there's been a lot of uncertainty. The stock down 22% on a trailing 12-month basis, even including today's rally. It's not in the Alzheimer's space. It's not in the weight loss space. When you look and talk to investors, they really go into those, call them sexier areas of investing. Cancer drugs right now don't seem to be that, but they did beat expectations. They did raise their forecast, so it does seem like they're winning back some goodwill from investors right now. Stock trading at $49.45, but again was north of 60 this time last year.
Anything else?
3M.
Post-its.
I love 3M. I think it's such a fascinating company.
I also it's fascinating. They are way smaller now than they were decades ago. I think my favorite thing about the Bloomberg Big Size and Scope news reporting, best day since 1987. Stock's up right now 16%. New CEO talking about how they want to grow fast. They're going to focus on expanding sales and bringing new products to market. But it's still just a shell of itself after spinning off and selling different assets.
And in 1987, they were actually known as Minnesota Mining and Manufacturing.
Wow. You know what I was doing in 1987?
You were not born yet.
I was not born yet, but
cool beans.
I didn't know there was a name for it.
I was here,
so that's
actually.
John
way cooler.
Decker.
Very seat.
He was still here. Were the flamingo socks here?
No.
No, okay. This is an important point. This will be the theme, guys, throughout the next couple hours. All right, Bailey, thanks a lot. You'll be back with us at the top of the 11. Bailey Lipschultz joining us, a Bloomberg News senior equity reporter joining us. Okay, to the ego data. We got that final read of UMich in July. It came in kind of bang in line with estimates. Current conditions ticked down just a little bit, but the expectations ticked up just a little bit. So let's call that a little bit of a wash, even though the S&P is still up by 1% on that news. The real data was the June number for PCE. This is what the Fed looks at. Personal income up 0.2%, spending up 0.3%, holding up. You also had a core PCE on a month-on-month coming in just 0.2% and 2.6% year-on-year. So they say this is status quo, John Tucker.
How Goldilocks-y is this?
I mean, or is it just a case of confirmation bias, like you see what you want to see?
Yeah.
Yeah. Let's have someone who might have an opinion on that one. Lauren Saylor-Baker is economist and senior consulting speaker at ITR Economics on the data. Is this data like a see what you want to see, or is this a Goldilocks for real?
Result to be, this is not confirmation bias. As we got the GDP numbers yesterday, the economy is still holding up, very resilient. Inflation finally coming down. It was a little more persistent, a little stickier than the Fed wanted to see at the start of the year, but all of the most recent months of data giving them what they need to start cuts in September.
All right, cuts in September. What about July 31st? We heard from Bill Dudley, even Mohamed El-Arian, the Bloomberg columnist, saying that they should get it done with, get it done soon.
I think that's the wishful thinking in the room. I do not expect the Fed to be moving in their meeting next week. If we could accuse the Fed of one thing, it would probably not be cutting rates too soon this cycle.
What do you think that well, what are we going to learn, though? Like, okay, they don't want to cut too soon, but to John Tucker's point, I get next week might be pushing a little bit, but what else are we going to learn from next week until September that will really cement anything? It's just going to be the same trajectory, right?
Well, that's their hope. So the Fed really does want, the word they're using is confidence, and to them that just means more months of data, additional data points coming in. So they don't want to move too quickly. I mentioned the very strong GDP numbers that came out yesterday. That will very likely be revised in future releases. So they just want to see that the inflation, as I mentioned, has been more persistent, has been stickier, that it isn't starting to creep back up by the end of the summer. Again, I think it's moving in the right direction finally, but because it took so long for us to get here, we had been on a nice, smooth disinflationary track. And then we hit that 3.5% range and things went much more sideways. So the Fed just wants to be sure this isn't a blip. We've had a couple of months of good data. They want to see a couple more.
Well, there's another side to their policy mandate, isn't there? And what's happening on that front? It has been cool.
There is.
Yeah.
Yes, the labor market is actually something they had wanted to see wage inflation cool. If we separate goods inflation out from service inflation, that goods side of things is well under control. It has been for some time now. It's the service side that's been held up by a very, very tight labor market. So they're watching, again, cooling labor has really been expected. Our labor market was just on fire for the past couple of years. I expect long-term we have a floor under labor market activity. We're starting to see the tide shift back in favor of a slightly looser market at the moment. I don't think we're going to go too far that way, though. It's just a demographic issue. We have baby boomers, that huge generation, finally retiring. We don't have a huge glut of workers waiting on the sidelines or aging into the workforce at this point. So the numbers aren't going to materially rebalance this. A little bit of loosening in 2024, but I think that's a temporary trend.
What happens? What happens more quickly when labor starts to cool? Does that really start to cool? Because it also affects personal spending as well.
Sure. Again, I don't think it really starts to cool. Labor has been supporting that personal spending component, which, again, about 2/3 of GDP driven by consumer spending. So that is the floor under economic activity this time around. We do see some echo effects from the pandemic still playing out in the labor market because things got so tight in that 21-22 timeframe. It drew a lot of folks into the labor market. So as we look at things like labor force participation rates for prime age workers, those are at 20+ year highs right now. Again, we've brought more of those workers back to the workforce. The risk now is if we start to see layoffs, or even if we just see more folks entering, again, I don't think there are too many of them left on the sidelines, but that could pull down some of that, say, unemployment rate. I don't think the fundamental drivers are there. And I think the ones that we're seeing are, again, a very temporary issue focused on 2024. 25 and beyond looks like that tightness will just be grinding tighter still.
Going back to the inflation point for a moment, we have seen freight rates kind of start to move a lot higher. We heard from like Chipotle that their costs are really starting to increase. Like they singled out the price of avocado. And I can appreciate that some of these are idiosyncratic, but is there a danger that certain type of inflation that we felt was done will start coming back?
We will always see pockets of inflation. I mean, avocados specifically, if you look at those trade routes, we get these odd kind of one-off events. So weather events, there's been a drought in the Panama Canal that is keeping ships from getting through, that's really increasing the time and the cost of that journey. So from an economic fundamental point of view, I wouldn't say that's the trend, but yes, weather events, these kind of black swan events, obviously geopolitics, that is the big one right now. I would not want to make any predictions on that front. That's not my expertise. But generally, if we look at major industrial commodity prices, right, raw material cost, most of those are still below the year-ago level. They're trending much more sideways than outright rise or decline. So I hope that's a breath of relief after a few years of very strong volatility, but we'll always be able to cherry pick those examples.
You know what I haven't looked at in a long time?
Tell me.
Just look at the yield curve, the inversion between 2s and 10s. It's less inverted-y.
Technical term.
Yeah, what does that tell you?
So the yield curve, it's a great rule of thumb that yield curve inversions tend to precede a recession. This time around, clearly that has not been the case. We've been inverted for, 2 years now, or going on 2 years.
But now it's just 18 basis points separation.
Well, we like to see that come under control. Looks like it might normalize sooner than later, but that was never a guarantee. We've had several historical cases, so a lot of precedent for an inverted yield curve with no following recession. So I think that's a fun rule of thumb. It certainly gives us a great look into, where the market is expecting things to trend.